Namaste, a very good evening. Welcome you all for this today's study circle meeting on the topic Emerging Career Opportunities for Young Chartered Accountants in the areas of fund management, our holistic approach to training and mentoring. To develop upon this subject, we have with us CABR Govindarajan sir. I request Chairman of Bangalore Branch, C. Manjunath M. Hallu, to kindly escort the speaker onto dais and welcome him with a floral bouquet. Thank you, Chairman sir. Dear member, I have privilege in introducing our today's speaker, CA B.R. Govindarajan sir is a chartered accountant with over 40 years of experience in audit, merchant banking, capital market, stock broking and proprietary investing. He began his career with Cooper Associates, followed by senior role at ECGC, PSU and CIFCO Limited, where he was a part of the capital market team and that managed 80 plus IPOs and the right issues, including Dr. Reddy Laboratories, Apollo Hospitals and TVS Motors. A former Madras Stock Exchange member and whole-time director of NSE corporate members, he has been an active participant in India market evolving since 1980s. Over the last 4 years, he has focused on intensive market research, data-backed testing, valuation modeling and global institutional investment practice, culminating in a comprehensive failed self-equity investment framework. He is currently dedicated to training and mentoring aspiring investment professionals, particularly chartered accountants, to become a client-ready equity fund manager, with ongoing guidance during their initial years. With this brief introduction, I present before you our esteemed speaker, CABR Govindarajan sir. Over to you, sir.
Good evening, ladies and gentlemen. This is the second session for me here. Yesterday, I had a session with the students, and it was very engaging and it was very interesting also. The feedback was very good. And I improved the today's session. I expect more feedback, so I have improved the whole session differently, and I feel and I hope that it will be interesting and thought-provoking to you. I will divide this session into 3 parts. First is about the opportunity. Why you should consider this opportunity seriously, along with your other whatever opportunities you have, the options before you. Second, the development of the market, the way the market functions, the way the whole setup is there, how it has evolved over the years, how it has grown, and what is the future. The third one is what I am going to offer, what I bring to the table, what I am going to train and mentor, and make you a wholly rounded fund manager. In this lecture, I am going to concentrate as a fund manager, as a fund manager for a big time investor like HNIs, big time HNIs, family offices, corporates, etc. It is not about retail investments. And I am also not going to talk to you about trading. Okay, it is only about investment, that too concentrating on big investments, so that it is a career option for you where the takings are very, very large and significant. And I am 100% sure that 90% of your people would not be aware of that opportunity at all, because you are busy with your other profession and earlier your exams or whatever it is. During that period, the market has moved tenfold, and the coming opportunities are much more larger and big, and then the fee and the other takings are very, very large, unimaginable. So let us begin with what is this I am talking about. First one, you have seen the slide. That is my offer to make you a fund manager. This is a fascinating career indeed to look at it, and you must look at it in a different perspective. Most of you would have some connection with the market as an investor, but some way or other, in mutual funds or in directly or only IPOs or whatever. But this is entirely different, where you are going to, or rather I am asking you to look at a career where you are managing others' funds, which means it is a different ball game, different responsibility, different perspective. So this fascinating career option is available to all professionally qualified people more than just graduates, because the area what I am talking about carries a lot of responsibility, accountability, and of course big responsibility in the sense the money what we are talking about is very large, ranging from 25 to 100 crores or even 500 crores. That carries much more responsibility than the money what you may otherwise invest on your own. You are not responsible to anybody. You are talking about a profession where it is altogether different from what you have been doing as a chartered accountant, auditor in practice, or in a manufacturing company, or in a financial services company, or in an IT company, or whatever. There the responsibility of course is there, is management at the board, but it is definitely much smaller than what you are directly accountable to your client. But I consider qualified CAs, MBAs and others are more suitable to carry that responsibility, because the kind of foundation that has been given to you by the institute is so big and so good, and it is considerably improved every year, year after year. The load factor is that you can conveniently and easily carry out. What you need is conviction in yourself and being fair and then sincere to your client. That is all. That commitment, if it is there, you can succeed. So look at this seriously as a career option. What is this about? Again, it is an option where the fee quotient is something running in millions of dollars if it is a foreign country, or in India, you can make your own multiplication. You build wealth for others, build income for you, and then again build wealth for you. Because the history shows that most of the fund managers have become owners of themselves, and after making money for clients and making good fee for themselves, most of them they say, we are happy, I'm sorry, I don't want to manage your money, I will receive it my own money. At that time, they also venture into other activities. For example, there is one gentleman called Govindarajan. He is the owner of DMart. He is one of the most successful fund managers, but he never did it with publicity and all that. He was very quiet. He was managing a handful of family offices and big corporate funds on a one-to-one basis for the last 30 years. He made so much of money for them, got his share, and then first he invested in BST Industries, then India Cements, and later on, organically he started DMart. Today DMart itself, the market cap is 200 lakh crore, 200,000 crores. Because he believed in a different model where all the buildings are his own. It is not rented, one. And he is the first wholesale trader who went into the franchise market. 75% of his goods are not his own. He doesn't pay for it. He encourages vendor development. So they come and display their items. Whatever is sold, of course he has got his benchmark and standard. Whatever is sold, he gets his percentage of cash. So he doesn't invest money in that. Only 25% is where in the normal way, like Reliance or others, he does it. So he started as a fund manager and made his money. Today he is like that. There are other examples. Ajay Junjunwala became an aircraft company owner. I mean, Akasam Airlines, it is his family's. He was only a fund manager. You can go on give many examples of different shapes and sizes. So, what I am saying is, this career will give you an opportunity to make money for others, and build income for you and build wealth for you. Age is with you. You can start now comfortably and it can go on for another 30, 40 years. Then your children can take over the legacy. So these are all a rounded up built-in career option which you have to seriously look into. Before talking to you about growth statistics, I will come to you why I say this has a big opening for you. Because the market what I am talking about, which is HNIs, if you look at the corporates or HNIs or family offices, they have crossed the level of middle class investment. They all of them hold their own houses. They have their own investments in gold. They have their own investment fixed deposits or fixed yield. Beyond that, the wealth they have only, they will come and invest in stocks. Okay, so we are talking about people who will compare investments in fixed yield securities and properties as a different option to invest. Fixed yield securities like bank deposits, bonds give a poor yield and it does not cover inflation. It is not hedged against inflation. Government of India, RBI, always try to keep the interest low because business corporates need funds for their own business at affordable rates. Already, if you compare the international rates, our rates are higher. Our borrowing rates of companies are higher than other developed countries. So, this is continuous conscious exercise by the RBI and Government of India keep the interest rate low. So, bond yields also are low. So, that doesn't give them enough attraction. Prevailing tax rate exemptions are not attractive enough to invest in fixed yield securities. Okay, HNIs can expect much higher return through stocks than FPI, obviously. The long-term capital gain provisions which is there in stocks it's a good investment, attraction. You may remember some 10 years back, long-term capital gains from stocks were totally exempt from income tax. Of course, they reintroduced it, and that is. But even that it is okay. You make money, you have to pay tax for your country. So that is why internationally it is accepted. Taxation gimmicks are said that it is not our cup of tea. All the corporates where international investors are investing, they want 100% compliance in any indirect or tax matters. They don't like companies which defraud the revenue. They always like companies which are tax compliant fully. You can avoid taxation by exploiting some loopholes or some structuring, but not evade tax. They don't like. So HNIs also, when they deploy huge money, they don't want any problems from the taxman visiting them. So they want to be compliant, 100% tax compliant. Within the four walls of law, whatever you can do, some here and there adjustment, they are fine. And so these are the reasons why fixed yield securities get defeated before stocks if they go for an option to invest. Then what about properties? As I said, these people have already owned properties either for themselves or for their business. So additional investment do not attract them because for two reasons. It will take 20 years, 25 years for a property to appreciate high, and then that appreciation will be enjoyed only by the inheritance. So in their life, they cannot enjoy the growth, whereas stocks will give them return in 3 years' time, 100%, 150% in 5 years' time. So people who want to be, in this generation, want to enjoy wealth, they would not like to invest more money than necessary in properties. The cost of administration in property, repair costs, etc. are also troublesome, particularly for NRI owners. High registered stamp duty is a dampener as an additional entry cost. These are all you are aware of it. But these are all pros and cons it weighs. Then poor liquidity when you go to sell is another issue. Potential litigation with tenants. What these The additional property they have to lend it out for a return. They are not going to have how many properties they will have and then they cannot reside everywhere. Whatever extra they have to rent it out. So the option is to whether you own a property and rent it out or you go for other investment options. So I say the property option is a lesser option for high net worth investors. So naturally, NRIs who are well settled abroad, when they sell properties, also they look for managing that by some professionals who can give them a decent return and file income tax returns and take care of the whole things easily. If it is property, the administration management has been given to some specialist companies to take care of it, and you cannot do absentee landlordism. So this is a much better option because the reverse of or the opposite of fixed deposits and properties is the properties of stocks. Hardly there is any maintenance cost, hardly there is any acquisition cost, and easy to maintain digitally, and then highly liquid. You can construct a portfolio slowly, methodically, using averages to bring down the cost. While you sell, you can sell it in small tranches to use the upward momentum so that you increase the average selling cost. You can sell one share also, you can buy one share also, which is not possible. One building only you can buy, one building only you can sell. So these are all the natural advantages that it is inherently available in stocks as an investment option for big time investors. And as you look at it, you are well placed to have that custom, the clientele, because you are already in a profession where you deal with board level members or individual taxpayers or SME or whatever it is, mid-cap companies or whatever. So it is what you call cross-referential complementary in nature. So the availability of business or rather clientele is much easier for professionals who are already in the service. So I believe that we are talking about a domain where everything is in place. It is up to you to recognize it and exploit it. Of course, after getting registration from SEBI, once you get the enough experience to be confident to handle it yourself, you have to register with SEBI, the regulator, and then you start working it. Initially, you have to start with smaller clients, and then once you are successful, you have a record to show, automatically business gets enlarged. And then at that stage, most of the people will reduce the number of clients and then concentrate on big-time investors. What is the future of a stock portfolio? You can invest in stocks, the biggest or the most top-ranked stocks at 20-25% discount. It happens every time. It is regularly happening. There is not one single stock anywhere in the world where you can say that in certainty, I can never buy that stock 20% less next year. Never. All the stocks will give you a chance to re-enter at a lower price. It doesn't happen in properties. Properties may not appreciate, but you know you cannot buy properties, good properties in any place at a discount next year. 5% lower rate, nobody will sell. That too, good properties in good places. Whereas good stocks, top class stocks, history repeat itself, will again and again will come back. It will come, and when you go to the seashore, you stand near the end of the sea. The water comes and licks your shoes. The same way, stocks will beckon you, come on, buy me, buy me, buy me. It happens with regular intervals. So that is the beauty of this profession, where the portfolio manager can confidently sit back and relax. My time will come, I will buy at my price. It will come. But what happens is, you are ready with 50 different companies.
Sir, reason?
What is that?
Reason?
I can't get it.
Reason.
Why that stock should come down to that level? By 20% discount?
Reason, sir.
There should be some reason in the market.
Not hearing?
Sir, reason regarding why the stock will correct 20% again,
I am coming to you.
and why not property?
Pardon?
Why not property correction?
Properties. Properties will not correct compared to stocks. It doesn't happen. It may not appreciate, but it doesn't depreciate. We are talking about good companies. We are talking about good properties. You can never buy a good property at a lower price next year. You cannot. But this is possible here. The reason is simple. Market always discounts the future. It has no interest in talking about the glorious past or inglorious failure. A bad company also can perform better, and if they can show that they are capable of performing better, the stocks will be preferred. Market will disregard the past. The same way, a top-class company, if it falters, if it is not good, it will give signals of some kind of a flat earnings growth or revenue growth or profit growth. Market will ignore such stuff because the confidence of the big-time investors lies only in growth companies. Companies which can show not only consistent performance, they have to have a 5-degree inclination where every year there must be at least 5% growth in revenue and 5% growth in profits. Market does not bother about post-tax profits. Market is more interested at the gross level, EBITDA profits, EBITDA rates. Because the post-tax profits vary from company to company depending on their taxation liabilities, their structure. Some companies are highly leveraged companies, some companies are asset-light companies. So the business model envisages the kind of structure they have. So accordingly the taxation, post-tax revenue will be different. But gross level, that is the true benchmark of the company's efficiency, how they turn over the resources in the operations. So the stocks, why it is available at 20% discount? It happens in Infosys, it happens in HCL Tech, TCS, Reliance, HCL, you name it. All the companies, if you go and see the historical data of the last 5 years, all the companies in India, why India? It has happened in post-COVID recovery. NVIDIA, Facebook, Alphabet, that is Google, and then Microsoft, all of them gave corrections. And today they are all quoting at the 52-week highs, career highs. So that is same thing will happen here also. The calendar differs, the period differs. Every industry has got some cycles. The same way, market also has got a cycle preference. This year they will prefer some 2-3 sectors. Next year they will ignore that. They will go after some other sector. That is the usual things there. That is the beauty of the market. So again and again in circles where the ups and downs are where price goes up and comes down and the sectors are ignored, that is where you get the chance to get it. These are all pre-planned and it is a function of the market where, like a giant wheel, it goes up and comes down sideways and then comes down and goes up. It's an economic process. So that is like the industry itself goes through cycles, stock market also, overall index as well as individual sectors and then individual stocks also go through cycles. That is where the opportunity comes for the fund manager. Once you are prepared with your action plan, you wait. The price you will get. If instead of A, you can get B. A will also come down after maybe 1 month, 3 months, 2 months. Doesn't matter. We are having our own preferences. We have done our homework, which we'll cover later, about the fundamental analysis. So we have already shortlisted what share we are going to zero in and watch that. And then when the right time comes, we will buy it. You are talking about discounts. What else you said?
Correction.
So the correction in the stock, you said,
Yeah.
and
I already-
in the properties. And so one doubt which I have is it the Dow theory?
Can you do one thing? It happens the flow of thoughts. Can you just note down At the end, we will have a question and answer session. We will handle one. All of you are welcome to ask any question you want related to the topic.
Yes, sir.
Okay, sorry.
Yes.
Features of a stock portfolio. Possible to acquire top good quality stocks like TCS, Infosys, Axis at 20-25% discounts to the recent highs, whereas properties will not be available at deep discounts. The stock portfolio can be constructed slowly over a period of time using price correction to bring down the cost of holding. That's what I just now said. Which is not possible in the case of property. It's a one-shot payment. While exiting from the portfolio also, one can exit slowly in small quantities in order to get a better price mix in a rising market, which is not possible in the case of a property. High liquidity. Properties can be sold overnight. Stocks can be sold overnight. Today T+1 is the norm in NSE. You can sell today, tomorrow it will be in your account. And there are many banks who are now, like HDFC, ICICI, their broking divisions are connected with their banks. So if you invest through them, you trade through them, they don't even use your money. It lies in your account. Okay. Whatever stocks you buy, at that time only they debit your account. The same way, no sir, just switch it off. The same way, when they sell, they immediately credit your account next day. Earlier, brokers were not paying the extra balance to the client even after asking several times. Okay. Then SEBI said, once in a quarter, all the brokers should pay the balance in the account of the client compulsorily by check. The client even does not have the option to give a letter to say, I don't want your check because I have to put it in a bank again, give you a check, and then in 2-3 days, I cannot operate in the market. Even if you give a letter, they have to give. The reason was they wanted to check the solvency of the broker. So the big banks have come out with an option for that. They said, okay, I will not touch your money. You link it with my bank. That process way, the banks also got additional accounts. So it's all with me. You have a depository account with me. You have a dealing account with me. You deal with my bank. So that the money will be lying and taking, you earn some interest also in the SBI account. And then I will use it whenever it is required. I will also credit the stocks sold to the account immediately. So the liquidity, what you enjoy, it can be never compared and never you can have it any other way. Even suppose you want to close a FD, it will take 4-5 days. You give a letter to the bank, the company or a bank, they will process it, then they have to calculate what is the cutting, they will do 1%, 2%, they have to cut as a penal rates, whatever it is, and then all sorts of things. And there you have to give, the branch manager will give sir big amount, they will ask you, why don't you give me 2-3 days time, year-end accounting suffers, please wait sir, all those things are not there here. You can anytime write royally sell and then take your proceeds. It can be encashed very quickly, and the cost of holding stocks, as you know very well, it's a fraction of percent. It is just 0.05%, something like that. Plus, of course, GST, transaction charges, etc. Because as an investor, you are not going to turn it around every month or every quarter. Normally, you hold it for 6 months, 1 year, or whatever. So the cost of running it in terms of brokerage and the GST is hardly anything because you will do one entry and one exit. So for traders the cost is more because they frequently buy and sell. The transaction charges by the stock exchange and the delivery charges and the GST are quite sizable in terms of total as a percentage to the total turnover. Why? HNI corporates, business houses need fund managers. They are busy with their work. obviously these high-net individuals are very busy people. They have their own business or whatever. They are occupied with other things. So they need professional managers to manage their money. They will never. They are successful because they are professional. They depend on professionals for everything. That is why they are successful. Their judgment pays off. So invariably they will trust a good fund manager with a record, and then trust them and then give them the fund management job. And many of them are not conversant with the fund management techniques and nuances. They have the capital, they are experts in their field, but they don't know what is this, right? So they will trust established fund managers, professionally qualified people, and then with some track record, definitely they are the right professionals for them to believe and then entrust their money. And most important thing, they are used to take business risks. They are an ordinary middle class investor. For them, the stocks are the least preferred because the publicity what we have seen in TV, on the cinema or whatever is that as if overnight people make money in stocks and overnight people lose money in stocks, because there is always a confusion between trading and speculation and investment. People don't realize that trading and speculation is different. Mostly speculation is an option futures market. Trading is possible both in option futures and in stocks, both. But investment, you are looking at a medium term, at least 2 to 3 years of horizon. That is what is investment. You don't expect a 3 months, 4 months period to make money. If that is the option, then it is speculation or trading. It is not investment. After all, for houses and properties or whatever, you are ready to wait for 10 years, 15 years. Gold, you don't bother about even it is growing up because it is a possession for your own taste. You want to wear gold as a jewelry form for social respectability. So you don't care about whether it goes up or not. I want to wear jewel, so I should be seen as a respected person. That is how it is. Now even jewelry, it has got its own preferences. This making charges and damages and all that. It varies from jeweler to jeweler. The mostly chains and other things have more wastage charges. Where bangles have lesser wastage charges. It is because of the preferences, the visibility. The properties also. People who care for more residential property than land. Actually, the profitability is reversed. Land gives more profits at lesser time than properties or buildings. That is, most people do not understand that. But only real-time property investors, they know that. Because a land as a plot is much more profitable than building. And that too, incidentally, we believe that we share this with others, that there is a trick where people say that when you invest in land, just 2 minutes I will share this with you, you must go for the plan. The minimum road width should be 30 feet at least, and the minimum property size should be 2,400 square feet. The smaller the road width and the smaller the properties, the properties will not be developing into a good high-class society. The reason is, these properties with high road, big road width and big size, it's expensive. Only people who can afford that, they will buy. So they are a different class in terms of keeping that area clean and neighborhood and then fellowship, etc., etc. So the whole area develops into a beautiful colony so that more people want to buy properties there. An adjacent area of similar thing, very nearby, but if the road width is 20 feet and then the plot size is 600 square feet, 800 square feet, you will get 40% less. That is how it is. The same way, in stock market also, in stocks, there are stocks which have a high pedigree where it commands high valuations. There are stocks with low pedigrees, it is available at low valuations. While valuation we are talking about, we will talk about how it is all different for different sectors and different companies and all that. So what I am saying is, people have their own estimation of anything what they buy, and the value they give for each of that class of investment. So even stocks, it is no way different. Within the class, the total class of stocks, there are a lot of difference over there, and different group of stocks carry different value. I say the management of funds through stocks is similar in developed countries speaking English. It is difficult for you to manage stocks for a German fund manager, German investor or Japanese investor, because the language they speak is different. You cannot understand the financial reports, you cannot understand the brokerage report. There are so many things which you have to read and understand to prepare, which is not possible with the language barrier. So, as a person who are familiar with English, it is easy for you to manage funds in USA, UK, India, to talk about three mature markets. So, the training and the experience you have as a fund manager will help you not only in India, because in the US, lot of our non-resident friends are there, relatives are there. It is so good in UK also, and UK has got their own advantage in the form of that is tax, post-tax funds given total tax-free status for investment in stock, zero tax. So a lot of people are now going into that in UK. So that is our opportunities, but they are all retail initially, not for HNIs there. Most of them salaried people, they won't have large money. But this, what I am saying is the training is the same, the technology is the same, the whole picture is the same, except some regulatory changes there in the respective country. Each country has their own method of trading, the transaction type, the facilitation, etc. This is what I said, our services. We have two services. One is to manage money for others. More than that, I am concentrating on giving training. The course objective is to create a fully equipped fund manager from CAs, MBAs, company secretaries, etc. within 12 months. And also handhold with them during the initial years of client engagement. The idea is that you not only get fully trained, you must also be confident enough to accept money, even during training or post-training, when you are a full-fledged manager, to accept money. At that time, after done all the work, you should not feel, oh, am I capable of doing it? Can I take the responsibility? Will I fail? No. Then, if you have any such doubt, we are there to step in to help you, to handhold you, and then put you through the paces. You are already well trained at that stage, when you are ready to accept, go for an agreement and accept money. But still, we offer that facility. The training period could be quickened depending on the requirements. That is an option available. We say, we will make you a top-class fund manager, which is the beginning, first slide itself is there. See, our strategies and execution cannot and will not fail. This kind of statement I am making not because of any arrogant position. It is purely born out of belief in our strategies and the conviction we have on our ability to find out the correct price and the correct time of investment and the exits. This comes more out of a scientific method adopted to understand the market through data crunching, through the emerging situations, and adapt itself to suitably to the evolving market conditions. That is a continuous market change will take place. You must be prepared to adjust yourself. You must be on the right side of the market always, not on the wrong side. So, our strategies and execution cannot and will not fail. What is a USP? Our USP, we say, is that market is so big. It will have, the prices are determined by the market makers and operators. You cannot do anything. That is it's a big ocean. But subject to that, you must have your own strategies to maximize the returns as much as possible through your strategies. That is possible when you use certain averaging and leveraging and entry-exit techniques, which are all openly available everywhere. You can understand that, you can use that to perfection, so that given the same situation of market movement from A to B, you can enlarge the returns by cleverly adapting yourself through averaging methods and leveraging methods. This is the one which we will be doing it under technical analysis portion. Let us come to the fee aspect. The fee income and asset growth potential of a successful fund manager in India and the Western country is really mouth-watering, which ordinary people can only dream of. It's a real, it's not imaginary, it is a real situation today. Fund manager fees are linked to performance and it could range in the mid-teens as a percentage to the profits achieved in the account during a year. See, we are talking about an average fund size in initial years about 10 crores. Okay, well, once you establish yourself, that is, it will take up 2-3 years for to establish. At that time, you may have to manage small funds, even 10 lakhs, 20 lakhs like that. Because that will give you confidence, that will give you track record. Once you graduate to higher level, big ticket investments, the average fund size will be 10 crores, slowly growing up to 20, 30, 50, even 100. There are many funds which are PMS people are handling 500 crores. And very highly secretive, nobody knows. Because of various reasons, the clients will say strict confidentiality. Nobody should know. Because India has grown so much that in Bangalore itself, I am aware of nearly 60 such 500 crores accounts are there. Pune is something less. Hyderabad has got much more than that actually. So this kind of potential is there, and at 15%, we are talking about a 30% growth average annualized return in 1 year, which is easily and possibly easily achievable. It's not that difficult because of your maximization techniques, what you should use. 30% of 10 crores in 1 year and have an average period of 2 years holding is 60%. Is 10 crores is 60% is what? 60% of 10 crores is what? 6 crores. On that 15% you calculate. That comes to about 90 lakhs. Right. Of course, as a fund manager, you have to consider GST because the fee he pays is subject to GST, and then your own taxation. There are methods available where, with the concurrence of the investor, you can avoid the GST and higher level of taxation. It is possible that you will know as a development yourself. By the end of the third or fourth year of practice, any reasonable successful fund manager can expect to make 3-4 crores fee, and which can only further go up in successive years. We will explain to you the calculation mathematics in person. I have already told you this. Okay. At present, there are at least 1,000 plus fund managers in Mumbai, Pune, Ahmedabad, Delhi, Hyderabad and Bangalore earning rupees 50 crores plus per annum and have built a network exceeding 500 crores wealth through fees and smart investments. Once you cross certain level, once you achieve certain success, the fee comes to you, becomes your capital. So you start investing your money prudently the same way you handle your client's money. So every year, in addition to the fee income, your asset also grows. A stage, as I said, successful fund managers, you also look for diversification from the fund management of your own money. You go into real estate or you go into some other businesses which you are familiar with, something like that. So the asset grows. Since you are well versed, somebody from your family can take over because your clientele is there. You have built up a reputation for fairness and sincerity. So obviously it can be bequeathed to your children. Any one of them can. The most interesting thing in fund management is except licensing by SEBI, you don't need any qualification. Of course, SEBI puts down that at least you must be a graduate. Then you have to write some examination, which is not difficult for your level to pass. But the problem will come later on once you become full-fledged fund manager, because regulatory filings are there, inspection will be there. But then, in which business you cannot, you can avoid regulatory compliance? Every business you have. So here also you have to contend with a regulator. So you need to have compliance manager, staff for compliance. So I have given you the picture of the market, which is the potential, the career, the prospects before you. I have also told you what is the fee basis available, what is the opportunity. Now let us start this comprehensive fund management training is in a nutshell. I will read it. We will give you a total A to Z, full 360 degrees training, both theoretical and practical training, and complete live investing facility on a token basis. The investment basis means instead of investing 100 shares, you can do one share like that, you can get trained. Then the method of training will be clear and simple, no jargons, no fancy methods and all that. It is very, very simple. As you learn, you will understand that we have to keep it simple. I believe in keeping it simple because that is easiest way to understand, easiest way to work. In life, when things are kept simple, it is much better. It's complicated, it definitely it does not give the results you want. Even, for example, a cinema song, simple tunes is more catchy and becomes popular. Simple lyrics are more popular. In life, everything, when you keep it simple, it is better. Some people will keep it complicated just so that others feel that it's something special. They don't know this fellow is telling. It's not like that. Yeah, the more simpler you keep it, it is easier to understand, easier to follow. So we want to cut out the jargons and then cut out the technical areas which are not at all necessary. That is required for investment banking, not here. Investment banking looks like fund management, it is not. Investment banking deals with many other areas. That is, you need specialized qualification, specialized exposure, specialized training, etc. We are not talking about it. We are not talking about trading. We are not talking about speculation. We are talking about investing for a mid-term period for high net worth individuals for a high return, for high fee portion for us. This is what is the subject we are talking about. Practical scenarios with practical experience through live and modern portfolio investment that will give confidence to manage HNI, ultra HNI and corporate corporate clients. Career focused. This training will be fully career focused. It is not about short-term profit. It is about sustainable and rewarding career in fund management. We are not going to change our thing in the middle and say it's talking about your personal investments or how to trade, how to make money in short term and all that. It is purely based on how you are investing money belonging to a big client. There is definitely a difference in managing your own money, a small money, and a small portfolio and a big portfolio. You will learn it when you come across. A smart portfolio is much difficult to manage, in fact, than a big portfolio. Big portfolio belongs to hardened investors. They know what is risk. They will understand short-term bumps. Small investors will not. And these people will give you a better leeway once they understand you and your capacity. And then the big corporates, it gives you more leeway to have free cash to use up when unexpected rewards come in the form of sudden drop in price of a few shares. So if it is a small portfolio, the amount available as a free cash for a buffer is very, very limited. with a big portfolio of 25-50 crores, you can have sufficient money to make use of any fall in prices of stocks which you follow. How to maximize returns? We have time-tested methods and strategies that for built mixing technical position of a stock which has already been shortlisted on fundamental analysis basis with clever strategies developed. This is what I initially talked about, maximization of returns. That is, and the market is the place where thousands of investors trade. The prices are there for you to see. You cannot do any change in it. It's nothing but demand and supply. But the demand or supply is determined by the big time market makers who deal in big volumes. We are all dealing as investors in small volumes. You cannot make any change in the prices. You have to accept the prices. Whatever is available at the price the buyers are there, you have to sell. Whatever is the price at which the sellers are willing to sell, you have to buy. You can fix your price, that is different, and you have to wait for it until it comes. Otherwise, you have to buy at market price if you feel that I want to buy today itself at the available price. Why a career in fund management? Consider the growth potential, consider the free potential, consider the low fund manager base, consider geographic flexibility, and consider the low overheads, which does not increase in proportion to the volume of AUM. The other four that I have already discussed with you. The last one is low overheads does not increase in proportion to the volume. Whether you have a client with 10 crores portfolio or 1 crore portfolio you handle, the manpower you require is the same. Even if you manage 100 crores, the manpower you have for 10 crores management is more than enough. Consider any other business. If you are a builder, if you are building a 10 crore project, you need 2 supervisors and 1 manager. The others are casual labor, plus office. If you are having an 100 crore project, you need 5 supervisors and 2 managers. If it is 500 crores, everything is the same way in the factories also. It's proportionate to the size of the project, you need manpower. Here, it is not like that. So what happens? The overheads gets compressed, whereas the volume of money managed goes up. So the fee. This kind of structure is not available in any other area. You look for it, it will not happen. Only in fund management it can happen. In a tight office with 5 people you can manage 500 crores comfortably. If you have already managed 100 crores or so, because you are already well trained and all that. You don't have to recruit more people. Because what you need to do is research of constant continued research of upgrading your list of stocks which are already shortlisted and the entry exit timings. Now that research is also available on subscription basis or free basis. So you don't do any research. There is no need. Professionals do it on a scientific way. Chemical engineers do chemical technology or that sector analysis. Pharmaceutical engineers, people who are familiar with pharmacy medicine, they do analysis of that sector. Like that, every sector is analyzed by specialists, and you pay a price for subscribing to that report. So, in addition to you are familiar, you are doing quality report, quantitative reports, qualitative reports. This outside report will give you further inputs. We also talk about need-based research, what you should do. Most of the time you get recommendation in websites, in papers about asking you to buy a particular stock recommended by others. That is a reminder to you. You can do need-based research on that particular stock, going through database to understand what is the company is, what the management, go through the director's report, annual reports, go through the last 4 quarters reports, what about the management comments. Then they have periodical talks to the fund managers, they give a report which is published there about their interaction with fund managers. All these things gives you a good picture about what is happening. More than that, the technical data will give you advance warning of what is happening. So the picture is that the cost of running a fund does not go proportional with the increase in the fund you manage, resulting in higher earnings growth. Growth potential we will briefly discuss. The parameters of all growth post reform process scheduled by Dr. Manmohan Singh in 1990. If you look at India, why foreign investors are coming in hordes and then investing huge, both in FDI and FII, is because we are a democratic country, there is stability. Both Congress and the BJP governments are following the same pro-capitalist policies with different routes, little bit here and there. So there is sustainability, there is democratic strength is there, and then most important thing, the companies are also doing well, their records speak. India is a consumption economy because we have to grow, more houses are to be built, more roads are to be built, more electricity has to be generated. So there is enough funds are to be invested for the growth in India. China has overtaken us and gone far ahead. We will also do it. So, but for the time being, India is a potential consumer market. That is what the foreigners are interested. So they have, after the establishment of SCM and the electronic screen-based trading, the dematerialization of accounts, and then T+1 settlements, quick buying and selling and encashment of we are attracting a lot of foreign investments. So that is evidenced by this growth. Market cap of Indian listed companies have grown from 35 lakh crores to 438 lakh crores in the last 20 years. That means the market cap, other than these other parameters, the market cap growth is larger because of some other reasons. That is, market cap is nothing but the number of shares available of a company and the market price. We multiply, you get the market cap. Okay. That has nothing to do with the shape and size of the company. Because different companies enjoy different share prices. It is reflected in the market cap. Whereas the other numbers will be more uniform. The Nifty index from 5,500 crores, it has grown to 25,000 crores, 5 times in the last 20 years. Number of listed companies in stock exchange has grown from 785 to 2,670. It is about nearly 4 times. Then you have number of demat accounts has grown from 50 million to 205 million. That is 4 times. Mutual fund holding value has grown from 15 lakh crores to 75 lakh crores. That is 5 times. Then equity mutual fund folios have grown from, and the figure I don't know the previous, but 24 crores, which is a significant growth is been there. This is the past 20 years. From 1990, when the SEBI came in, post-liberalization, first 10 years or 15 years, they were not sure about what is happening. People were not knowing about the development. We were all settling. In 2001, 2002, the big IT sector boom came, where that sector secularly grew up 20 times, 30 times, like that the prices went up to attract attention. And then they also grew, not only in India, outside India also, offshoring and then professional growth of people who are migrating to other countries also. In fact, today, our rupee is becoming weak more because of the dollar strength, which is again linked to the visas and then the problems we have, because we are more linked to the American economy in terms, for example, for our forex growth. We are, other than in addition to the remittance from foreign exchange, the trade surplus we have in America with the US is 5:1. That is why they are arguing with us to reduce it by importing more from them. Whereas China is reverse, it is for 1:5. China, we import more from China. In the US, we export more to there. So now the dollar is taking a beat because of the problems which we are facing both in tariff and in visa regulation with the US. I read in the paper last 6 months, the Reserve Bank has spent $12 billion to strengthen the rupee, and then finally they realized that it's futile. it's falling. Whereas there are other reasons that our gold imports are also surged because to avoid smuggling of gold, they reduce the import duty. So the import duty, when it is reduced, the consumption went up. So we pay in hard currency to buy import gold. Anyway, we are net importers of oil. That added to that. Then the foreign investors also selling continuously for the last 3 months, which means they were selling rupee. All these efforts, all these features brought the downfall of the rupee. So temporarily stock market, though index is up, several stocks are available at good discounts. This is one of the reasons what you can't factor in. As a fund manager, you must be ready with money to make use of such opportunities. But it happens regularly for some reason. Some reason will come. Reasons will be different. But then the matter is the same. You get opportunity to enter at lower prices. That is the blessings for people who are investing in stocks. There's nothing that you have to buy today. Tomorrow will always be there. You can always wait. You should have patience. That is what is our advice to whether you are individual investor or fund managers or whatever. So you have seen the growth potential. This is what has happened, I am told, is only a trailer. The main picture is yet to come. The growth from years to forward, which is much more higher because the government capex also is increasing year after year. The private capex is also matching them. Which means more investments are being made both in the private sector and the public sector, particularly in infrastructure, in road, power, and then whatever other steel, cement manufacturing, and oil wells. And then now today they are talking about semiconductors, they are talking about various other things. Defense, they are making more defense equipment within India, they are building more ships in India. All those things are newer development. We never thought we are going to pump in something like 75,000 crores in 3 years in defense shipping. And we are also, now we are shipping, we are making ships for other countries also, small frigates and all that. Our Mazagan dock and then that Cochin shipyard, they make small ships for other countries because it is cheaper for us to make. So our growth in terms of industrial growth and economic growth translates into a larger outlay in stock market. More IPOs are coming every year. This year itself we have record IPOs. So this is going to come with more and more new companies coming with new paper coming. There is more options available for stock options available to choose from. Future possibilities. With our account that I already covered it. Even moderate inflation can make fixed income securities less attractive, and with further tax incentives possible for equity as a class, which now witnesses only moderate taxation, we can explore as an asset class to unexpected levels, as it has happened in many developed countries. So, again we are stressing the same point that what is the glorious past is only an indicator. The future, what is beckoning us, is much more brighter. And then it calls for more efficient individual fund managers. So far, this as a career option has escaped the attention of professionals in India. That is what I get to feel, because I do not find many offers by the people who are giving coaching centers, coaching offers, training offers, etc. Because when the market is not there, who is going to do it? It simply says everything is matched. When you only have students, you can have a teacher. It's not vice versa. So I find, and I also made inquiries saying that this has not percolated to all the potential qualified people in all these institutions like CA, hospital management, company secretaries, etc. And company secretaries and cost and works and management accounts, mostly they are industrial sector or that sector only they go. They don't do any practice in a big way. So most of them won't be interested in fund management. Fund management is an area which is liked by Gujaratis. That is their bread and butter. They graduate normally most of the people who are successful fund manager have Gujarati origin because it is in their blood. They are slowly graduated to higher level of responsibility. But the MBAs and IITs are going abroad, are going for this, startups or angel funding or other, digital and fintech companies like that. Because that is a different field where a different type of I don't want to use names, something else is happening there. So the road in front of you is very clear. There is no traffic. This you have to compulsorily look at it. All these things I already discussed. Additional fee area. The complementary nature of fees which can occur here is, it is a circle. Your client is a big NRI or HNI. Naturally, he will be selling his property when he settled abroad or here. So, I don't find, you also may be aware, there is no proper qualified people to do the work of vetting title deeds, doing the registration, and then doing the tax returns, and then transferring the funds abroad in forex, going through RBI for approval, everything as a wholesome product. No. For registration, you go to a typist who works in the sub-registrar office, who does a copying of this, which is in the computer. He does not know. Sometimes you will find old names will be there in the title deed instead of new names because they blindly copy. It can happen. You must be very careful. And lawyers are very busy. Of course, banks have their panel of lawyers. If you go to a bank, they will say, go to one of my panel lawyers and then get the thing vetted. That is different. But the practice where you can deal in real estate around some practice, which is complementary to the stock market. Money can flow from here to there, from there to here. Because once somebody is a client who sells through you, when he finds that you can offer a good solution to invest that money, he will definitely look at it. That's what I am saying. Additional fee area is mostly related to properties, sales, tax filing, funds repatriation services to NRI clients, tax efficient investment solution to NRIs, loan against properties arrangements, fund management for NRIs in their own country of residence. If they happen to live in the three countries, I mean England, UK, USA, etc. What's the time now?
6:15.
They wanted to have a break, tea break, something you was telling. 6:15, any idea, sir?
6:30. 6:30.
6:30? Okay, we will go now. Now, I am coming to the more interesting part. It's a topic snapshot. If you go through all the topics, we will discuss each topic where the entire market operation, the whole thing will come step by step. Capital market evolution and functions. What is a functional evolution? I already discussed. If you look at it, before 1980s when I came to the stock market, we had very limited listings, mostly in the form of tea estates, coffee estates, some manufacturing companies, etc. In 1984, the government of India compelled more British and foreign-owned companies to list their shares in India. Otherwise, they have levied a high rate of income tax. So, most of the British companies and other foreign companies opted to list their securities en masse during 82 to 85. That is the time where I managed a lot of IPOs for a Bombay-based company. At the time only, in South India, we managed the issues from Apollo Hospital, Dr. Reddy Laboratories, Ashok Leyland Finance, TVS Motors, Sundaram Gate, and all those issues I managed on behalf of a Bombay-based company. But more interesting was the Sterling Company's Indianization, Vera Company's Indianization. All this Procter & Gamble, all Glaxo, everybody came Indianized by listing it in 1980s, 84, 85. At that time there was no SEBI. We had to go to the Delhi Capital Issues Control Office. They used to give premium like, they say, if the premium calculation comes to 100 rupees, they will give 5 rupees. Their idea was that the investor should make money. Today everything is reversed. Where only the management makes money, the price is so high. Many times these days, the management itself sells. Their promoters sell. Obviously, they are not shielding it from you. It is available in the prospectus. It is still offered for sale. Existing promoters or part investors, they sell. The recent past, it is a phenomenon which people are worried that this year, at least 40,000 crores worth of stocks were sold by promoters in the IPOs. Very little capital went to the company. Mostly, existing shares were sold. That is another racket, let us leave it at that. So, what is it? Evolution and function. The function of a capital market is essentially assist capital formation. The capital is required by businesses in whatever field they are. So they put a document called prospectus and they seek subscription. As a shareholder, each one is a part owner of the company, and then the company which you trust does its business, makes profit, pays its taxes, and distributes what is called dividends. Based on the company's performance, the stock price goes up. So when you feel comfortable, you can sell and exit, part by part, or fully, or immediate, or whatever it is. The function of a stock market essentially to give liquidity in and assist capital formation. There are regulators available. Originally it was the Government of India Stock Exchange Division. Now it is all given to Security Exchange Board of India. RBI regulates and oversees for foreign investors and their entitlements, etc. They only decide how much percentage foreign investors can hold in India, Indian companies, etc. Capital markets regulator, as I said, it was originally regulated by the Ministry of Finance, Stock Exchange Division. Now it is managed by SEBI. The National Stock Exchange, which is the main exchange which functioned under SEBI, which came into being in 1991-92, is the principal stock exchange in India. In those days, there were 30 stock exchanges there, regional stock exchanges. In Tamil Nadu, we had 2 exchanges. In Karnataka, I think we had 2, Bangalore and Mysore, I think. And then in Gujarat, they had 3. But in 1990, government suddenly decided, NFP said, we don't want small exchanges, we will have one big exchange. But they spared Bombay Stock Exchange, which was a 100-year-old premier exchange. That is still there. But the total volume of business in NSE in Bombay is 1:20 today. Such a big institution has been marginalized. Because the foreign investment institutions, they are always following stocks which are listed in NSE. They don't prefer BSE because of liquidity reasons. Then that is capital market regulators. Then we come to the next heading, stock selection on basis of fundamental analysis. This is the topic heading. We will go to the section headings, it will be different. That we will talk about technical analysis, fundamental analysis, both qualitative and quantitative. That is the one which every fund manager goes through. That has to be studied in detail. We will go through that. Then stocks, buy, sell, timing through technical analysis, research, fundamental and technical research through annual reports, sector-wise, industry-wise macro analysis, value versus growth, conservative, fail-safe investment methods, maximization of returns, compounding versus regular encashment. These are the topic snapshots. Then we will cover various topics one by one. Topics covered is function of the capital market, economic studies related to capital market, evolution of growth of capital market players, leaders and followers, role of financial ministry, SEBI, RBI, importance of foreign investment institutions, domestic institutions, role of the media, role of research houses, importance of research, need-based research, paid and free research reports, analysis of companies' annual reports, IPOs and grey market, NSE and trading and clearing mechanism, NSDL, CDSL, 2 depositories, evolution growth of mutual funds, role of different market players, market makers, market movers, market activists, all are one of them synonymous. Stock selection, preparation of eligible stocks through fundamental analysis, what to buy and market perspective, the changing market perspective. Quantitative, P&L, balance sheet, cash flow ratio analysis. Qualitative, management equity, corporate growth, brand value and strength. Innovation, market share, regulatory factors, local and international tariff, inflation, interest rate cycles, etc. Economic, industry analysis, sectoral watch. Capital structure, paid-up value, holding pattern, promoter pledges. These are all coming under quantitative analysis. Qualitative analysis, ratio analysis, balance sheet analysis, profit loss account analysis, you are all familiar with, you are covered. But this you might not have come across. In most of the fund managers, they give more weightage to this because this is non-published information. Then the company overview, business model, competition, segmental position, ownership data, promoter holding changes, institutional holding changes, activist, investor activity, management team, high margin companies, low debt companies, low float, undervalue, takeover targets. Market cycle watch, sectoral chart, market giant wheel, asset light, debt free companies, turnaround stocks. Peer group analysis, market leadership, revenue, EBITDA, year-on-year growth and quarter-on-quarter growth. Stock pricing, valuation, absolute, relative, own current peak flows. Valuation metrics for different sectors, different approaches. Stock valuation through capital structure, paid-up value, floating stock, institutional holdings. Technical analysis, when to buy from stocks forming part of the fundamental criteria-based list. Accumulation and distribution, this is the most fundamental phenomena in the market. This is the most important thing which you will come across. Accumulation and distribution patterns, identifying movements. Leading and lagging indicators, chart analysis. Importance of volume data, weighted moving averages. Retracement theories and their significance. DMA, Fibonacci retracement, bull bear crossovers. Quarterly result, technical analysis before and after publication of results. Large cap versus mid cap preferences. Why mid cap returns are higher, ownership pattern, option market compulsions. Power and pitfalls of compounding. Compounding was a periodical profit booking. Handling unexpected adverse news, adversity to opportunity. How you can make use of adversity and convert it to opportunity. Fear and greed phenomenon. Conviction with confidence in more strategies, prepared to wait for results with loads of passions. For the same USA and the UK market, the same topics, the same methods or methodology is used, the same expertise is enough. Finally, we will be talking about maximization mantra, that is enlarging the return ratio by 100% through proprietary strategies. That is the ultimate, because all our efforts will be there to increase our return. That is the objective of that. It's not that you perform along with the market and then you take the market returns. It's not possible for us to buy at the lowest price and sell at the highest price. It is not possible. If it happens, it's only a coincidence. Invariably, we will be buying at a higher price than the bottom and selling, exiting below the highest price of the year. But at the end of it, you must have our return. That is the objective. We want 40% return, we must work for it. We want 30% return, he is happy, work for it. 20% return, work for it. It is all the objective of the fund and discuss with the client. He says, okay, I want this, I want this, I want this post-tax return, I want this hedge type risk covers return, I want this, I am willing to take more risks, you can do it. I am willing to borrow more and do higher leveraging. There are so many, you discuss this, the protege, the structure is discussed with the client based on his requirements. He may say, okay, 30% you invest in fixed income securities, 20% you can invest in gold bonds or ETFs. It's part of my total money, you manage that also. Then you have to do it. But that is not of interest to you because that doesn't give you any yield. Your yield comes mainly from managing equities, which gives you, in our conservative method, is 30% per annum. On that 15% is 5%. Something like that. That is what is interesting. On a larger fund base, the income is very substantial and it keeps on growing. And as I said, the net level, it is depending on the structure of the legal structuring of your agreement with the client, the net level will change. Gross level will remain the same. Net post-tax income will change depending on the equity structure you have. The legal relationship with the client. Now let us adjourn for tea. We will come back. I think for another 2 hours we will have cover all the topics and then the question and answer session. Thank you. So, we will come to the detailed topics wise. We will go through one by one. First, we will understand the functioning of the stock market in general. It is not an ideal place. Like any market, it is dominated by demand and supply, and it is dominated by the market movers and makers. It is a reality, we have to accept it. It does not function the way you expect to function. For example, a good balance sheet and profit loss account, a good structure, good profit does not necessarily mean a growth in the stock price. Or if there is a fall in the profitability or some adverse news does not necessarily reflect in big crash in the stock price. Because the market always discounts the future. But it has got some funny methods in discounting the financial statements. The demand supply is the main function of the market, but it is dictated by powerful groups called operators or individuals, syndicates called market makers and operators. Each company has a group of people who are close and privy to the management. They invest large amounts of money only in that company's stocks, and they wait patiently, they accumulate and they distribute. The entire market function is that accumulation and distribution. That is what is market. You are part of that. You must judge the accumulation process and enter along that, and you should understand the distribution process and then distribute or exit along with others. That is the continuous exercise. The market is dictated by powerful groups called market makers, or individually or syndicates called market makers or operators. Process of accumulation and distribution is the function of the market. That is, all over the world, it is the process. It's a continuous process. You have to identify that and go along with the market. Corrections is inevitable. Correction prices is a process of the market, it is inevitable. Consolidation is also inevitable. After correction, it consolidates sideways and price does not move much. That is the function of the market, that is how the operation takes place. Then retraces. Depending on the news flow and the performance, the stock price retraces. That is another function. Then new highs are reached in some cases. 100 rupees, 80 rupees, 100 rupees, 120, something like that. It's a new high. Volume of transaction is the key, which ordinary investor is not aware of. A market follower, a fund manager or a specialist will watch the market on a daily basis and follow the volume. Volume, the minimum base value is very, very important. Then the norm also requires you only invest in companies with a size. of say 3,000, 4,000 crores market cap. And those companies which are traded actively in the market on a daily basis with a volume of at least 5 lakh shares average. That means liquidity is there. And then you are talking about volume of transaction is the key. Historical data is available freely and also on subscription basis, which should be watched. The volume transaction combined, which is evidenced by the historical data, that tells you the story. That is, that what is happening in that particular stock. The data will vary according to the stock and the particular stock's news flow and the season. Normally, every quarter the companies declare unaudited results. Before the result publication date, there will be some continued activity will be there where the stock price may come down or go up. Invariably what happens, once the stock price already has moved sufficiently, good results also will not make the stock price go more. That is what something we call the news is out, the baby is born. For example, the company announces bonus shares. Until the news board meeting is announced, the stock price will go up. Once the board meeting is announced, for about 2-3 days they have to give 1 week notice. It will be lying higher. But once the news is out, where the retailers will buy, the price will crash. Because already it has moved up sufficiently, anticipating a news. That news has come, there is nothing more to imagine. So volume of transaction is the key. Historical data, valuation matrix is very, very important because that is the one which you have to judge the price you pay. The market price you pay, it will be more than the intrinsic value or less than the intrinsic value. If you buy less than the intrinsic value, you are a value buyer. If you pay more money than the intrinsic value, you are a growth buyer. That means you are ready to take more risk because you believe technically or whatever reasons the price is likely to move. On a short term, you want to encash it. So volume, valuation is very important. Always be on the right side of the market maker. That means if you are buying on dips and on correction, you are with the market maker. That means the big people who move it. That is why, because of their action only the price comes down. Because they have sold out already and they are publishing bad news with the intention of buying at a lower rate. That's a continuous activity. So, when you are buying a correction, you are also buying along with the influencer. It's not vice versa. The ill-informed people, traders, they buy when he sells and they sell when he buys. The more intelligent manager will go along with him. The trick is to be on the right side of the people who are powerful, who move the market. Even if you are a long-term investor, your aspiration or aim should be to buy low at the lowest possible and bring down the average cost of holding. That is how you can make more returns. So it is not as if I am holding for 3 years, I will just go and buy all the stocks at current prices. No. What you do is a good efficient manager will allocate resources to X number of stocks within the portfolio. Suppose I have 10 crores, I will give 20 stocks, each 50 lakhs. For the entire 50 lakhs, I won't buy in each stock the same day. I will keep in each stock 10% as reserve money. First, that I will not use it, I will never use it. That part which balance 40%, 90%, I will invest over a period of time. I know I would have become an expert in understanding the stock prices of a concerned stock through technical analysis. Enough indications will be available. Ordinary investors, they don't go through all that. They don't have time. They only go through the news flow and then take risks. A trained investor will always go through technical analysis on the need-based stocks which he has already shortlisted. He won't waste time on all stocks. It's too difficult to follow so many stocks. I am interested in these stocks, I am a follower of these stocks. Only in those stocks I will do research, technical analysis on a regular basis. And then upgrade the data available on a continuous basis so that I can change my opinion to make an entry or exit or average or leverage or whatever it is.
1
fundamental research and make constant upgradation, review of your buy list. That is what I said just now. There are two lists. One is the buy list, another is what to buy list, another is when to buy list. When to buy is the current list, what to buy is permanent list, which is reviewed every quarter and then upgrade. Some one or two stocks you may throw out because you are not finding good news or good development, and then replace it with some other stock. Naturally, the ratio of the what to buy list will be 5 times more than the ratio of shares you actually buy, because you may not get the required price support for all the stocks you want to buy. It's a wish list only. Only some of them will come to your level of entry. So, doesn't matter. I am willing to buy any of these stock provided the price is right. That is how the fund manager goes. He is not, no, I want that stock only I will buy. There is no, in fact, there is no affinity to any particular stock. There is no emotional attachment. For me, A, B, C, D, all are same. I am putting money, I want return. I don't have any preferential attachment or emotional attachment to any stock. If you have emotional attachment, it's not good for you. It's not that. You should not have any emotional attachment. That is only for your relatives, not your children, not for properties or stocks. In fact, our forefathers are one, you don't have material attachment. That is indirectly like this only. You don't have material attachment, emotional attachment for this kind of stock. I have come across many people who say, I've been holding this share for 20 years, I don't want to sell. My father has given it, I don't want to sell. That is all not correct. You have to take a realistic view, it's your money. So you have to take a decision whether to hold it or sell it, or then sell it and then buy the same stock after 1 year when the price is corrected, you make money. It's not that when you buy and sell, you make money. You can sell and buy also, you can make money. Many prudent investors, what they do, if they have 1,000 shares in a particular company, they watch the market. They know, I will sell part of that at the peak and buy that back after some 20% discount, the same stock, because it's already in my radar. So why I should have idle stock? I will trade on that. That's the correct method to accumulate more returns for you to have build up higher average. That is also possible. In fact, the traders, what they do, they pledge the stocks and take a limit and they accrue it. That is dangerous. In fact, you should buy and sell and buy the same stock. That also generates cash flows and profits for you. That is good. That's ideal. Because once you have made an exit, if the same stock comes down and then invites you by me, you should consider it. That does not mean you have sold it, it's bad. It does not become like that. It is a price market has asked you to sell, you have sold. It is now asking you to buy, you buy it. That is, you cannot make total exit from any stock portfolio as a fund manager. It's only partial exits. Any fund manager, no, you will never make total exits in a particular stock unless there is compelling reason. You will make only partial exits. The other, you will buy back that and then keep the same allocation that are available. How typically it is done? I have 20 stocks. During the process of constructing the portfolio, I might not have fully invested all the money I have, because by the time I have invested, say, 50% of a particular stock where I have allocated, say, some X money, the stock might have moved up. Just because I allocated money, I should not go and chase it by a high price. No. Once it has moved up, ignore it. Let it move. Then you have to look for an exit, not entry again. That extra money you have, you can invest in some other stock within that allocated limit per stock, so that you don't touch the extra reserve money. Okay. That is how typically all professional fund managers they do. Even in mutual funds, that's what they do. They keep on selling part of their holdings and then they buy it back. In the same way, individual PMS managers also will do the same. Investor also can do the same thing. Do fundamental research and make constant upgradation review of your buy list. Do technical research of timing entry, averaging, leveraging, exits and re-entry. Wait for the correction of the market always. Never chase a stock. It is like boarding a train when it is in the starting terminus, not in the midway station. Because the train may have start from Chennai and go to Delhi. You don't have to necessarily wait for going up to Delhi. You may get down in Agra, or you may get down in Rajasthan, you may get down in Nagpur, whatever it is, because you are happy with your returns. But if you have boarded the train in, say, Kasipet or in Vijayawada, already train has covered some distance, you are buying at a high price. If dilemma comes to you, when the price corrects from there, what should I do? So I always believe through technical evaluation you must find the bottom. You start buying at that price only. Normally, even from there the stock can come down, but the bottom will be very near. And there will be enough indication through the data what you collect on the market movement on a closing basis every day that it is consolidation. We always believe that price consolidation is one thing and time consolidation is also essential, because that is how the market makers move. They don't want, they are very, very patient. They make their moves in a very, very calculated manner. All successful people, in whatever business they are, they plan it and they do the execution to perfection. Now, nobody does in a facade way, then they will only lose. You have heard of horse racing. Owners are there, they are putting a lot of money to buy horses. They plan when they want to win, how they have to win, how they plan to win. A lot of planning goes on. The prospectus is released by the various race courses. That prospectus tells which are the races fixed for what type of group horses. So this man will train his horse attacking a particular race. Who are the opposition? What chances I have to win? And can I back my horse? A lot of planning goes on. In horse racing, theoretically, all the horses which run in a particular race are expected to win. That is how the horse or handicap or weights are given. Let us not go deep into it. What I am saying is, even in the gambling, essentially, which is race running, lot of strategizing is done by the owners and traders. So, everywhere, whether it is fund management or it is construction, they also do a lot of planning. You need to plan your resources well and then make the movement. Your operators or the market makers, they do a lot of planning. They know more because they invest so much of money. They are very close to the management. They know the calendar events. They know what are the new developments, good or bad. They know any new developments or adverse developments will be published when it will be released to the market. Everything they are aware. Some of them are available to the market in the form of conference calls which the promoters have with the research houses or fund houses, which is published by the websites itself, or in the NSC website also they publish the transcript of conference calls. That tells what is the management's objective, their plans for new investments, organic growth, inorganic growth, or whatever, product launches or whatever. So some information is available, some timing is not available. So market matters plan their kill according to it. So it is essential that even if you are not aware of all the development, you must make use of the corrections that comes to you by data crunching. That is what is the one which assures you. You don't have to worry about news as secret information, all those kind of things. That is not necessary. That is important for traders, not for investment. If you cannot invest clients' money as a responsible investor on hearsay, on unverified news or data. You have to be very careful with the money, and so you must only invest based on verifiable data and which is fully tested by the news flow that comes from the source it comes. Now we will cover each topic from the function of the capital market, the function, the formation, investment of people saving is the very essence of capital market, where capital formation is there for taking investors' money, and then the promoters borrow some leverage money from the banking system and they run their business, which is given in the document called prospectus. And then based on the results, they declare dividends and declare bonus shares after some years, and the price market moves. The players, the investor, they can continue or they say exit or do whatever they want. Economic studies related to capital market. The economic studies mainly relates to both the macro level, which is about the sector, and micro level about the company. Both are available in websites, which is paid websites or free websites. The individual companies, in addition, you need to have technical data for company wise, and then the macro data sector wise. In fact, even sector wise, it is possible to track the movement of that particular sector stock prices. The top 5 market cap companies in each sector, which will account for 80% of the market cap. For example, a sector may have 20 companies, but the top 5 companies may account for 80% of the market cap. So it is enough for you to follow the growth of that sector or the degrowth through the analysis of the market data. If the stock price of those companies are moved up, then you know that something is happening for the entire market. Today, if you look sector-wise, pharmaceutical sector, certain types of pharmaceutical companies their stock price have gone to 52-week highs. Certain pharmaceutical companies are within the sector, they are not moving up because the impending news in those sectors that subgroups, they are doing extremely well due to various reasons, including supply of Chinese chemicals or non-supply of chemicals, tariff guidelines or whatever it is. So every sector, when you believe that it requires re-rating, it can be seen through by the data available on data crunching. It is possible. Then first you understand the sector is moving up or it's coming down. Then go to the company wise and do the research. Then you will know that yes, this is the share which you can back up at this price, or it is one for watch, we can buy 10% lesser. And then based on the news, what do you call, historical data which is emerging, and based on closing prices, you can make your own judgment. Role of Finance Ministry and SEBI, I have already discussed. Finance Ministry is the king of the whole thing. It is the one which gives direction to the Reserve Bank and the SEBI through its directives about how they want the capital market to be there, how the investor can be protected, how the market can be given fillip through taxation measures and other measures, so that the market is vibrant and the more capital formation happens, lot of money comes in hard foreign exchange from FIIs, and more FDI money comes, which is not listed, or not unlisted shares in the market. So the government of India, without their support, this market would never have grown. So many FIIs would not have pumped in lakhs of crores of money here, and the mutual funds would not have grown. And the whole thing has grown because of the government of India's initiative and backed by their organizations like SEBI, RBI, and the stock exchanges. So many other side players are there. You see the stability in the form of the infrastructure which has developed in the last 20 years. What kind of screen trading, so transparent, so simple and easy in your home, you can do in a laptop. Okay, then the money is safe with the brokers because it is under scrutiny of the investors, the SEBI. Then it is highly liquid. You can construct your own portfolio even as an investor. These are all evolution which we never saw in those days. We had to fight with forged share certificates, forged transfer forms, and then illiquid shares and whatever it is. You look at the IPO market. IPOs are listed within 10 days these days. Those days it takes 3 months, 2 months and all that. And then the refunds will never reach the refund checks. Most of the time will last in postal transit, or it will never reach because of certain frauds. Lot of technical, infrastructural problems we used to face when we were stockbrokers. Today, the stockbrokers You do not have to contend with this kind of organizational problem. Everything is clean like a highway. The problem lies in what is improvement required is in the valuation. The valuation is on the pro side of the investor, that is the issuers. They don't care for the investors. They say, I am asking them to put big risk factors and big prospectus and then declare everything so that the investor can take informed decision. How many prospectus are printed? You get an application form which has got 6 pages with small fine prints. You need a magnifying glass to read that. Like the insurance documents of 6 pages, you don't know what are the subclasses. The same way you don't know. The promoters happily put all the risk factors there, all the negative flows also. They know that people will never read. They go by, I am aware of the new issue market, how it functions. There are people who follow the market. The market, the IPO opens on 10th, it closes on 13th, okay, or 12th. On the 12th morning, they will see what is the oversubscription, what is the grey market premium. The oversubscription is more than 20, the premium runs more than 30%. The last day they will apply. And they know they will get only a small percentage of the what they applied. Okay? So they are happy. I apply for 1 lakh, then I get 10,000 allotment, that I can sell for 13,000, I am happy. But he doesn't lock up his money, he's got ASPA, he only gives an acknowledgement if the amount is not touched until it is allotted, and that too the allotted share. And when he sells it, next day the money comes to him. So he does fast turnover of his money allocated for IPOs. It was not possible in those days. Today, IPO market, though the price is very bad, the issue infrastructure is excellent. The stock market operation is beautiful. The screen trading methods, the demat accounts, the banking system, linking, everything is in parallel with any of the advanced countries. We have reached that stage. There is no further growth is required. But these are all plus points which attracts so much of investments in mutual funds. How much folios are created? The average holding per mutual fund, I am told, is increased from 3 lakhs to 4 lakhs now. How much I said? About 14 crores folios. Consider how much of increase in the subscription by retailers, how much of faith they have. So much of money is coming from fixed deposit markets to mutual funds. So that is how huge selling by FIS in the last 1 year the market could withstand. They have taken out something like 10 billion or 15 billion in the last 1 year, net outflow. The market did not crash that way. Even the rupee did not crash to that extent. There is so much of outflow because the strength of domestic market, the domestic investors. These are all important for you to say the stability. This is where we are looking at Rajapata and so on. I mean, in the sense, it is a highway. 6-lane highway, you can go as fast as you can. So we are in a structure, infrastructure is excellent. Only thing is you must be intelligent enough to spot the opportunities in the market through fundamental and technical research and then construct your client's portfolio, whether it is yours or the client. Function of the capital market, economic studies related to capital market. There used to be a publication called Center for Economic Research, CMIE data. That was the Bible for us in those days. Now there is lot of other data is available. Even Economic Times or Business Line, all those magazines also have devote lot of time for this kind of industry data or industrial research or whatever it is. Then published data is available, very, very good sites are there. The big banks like State Bank, Axis Bank, HDFC, they also have research reports which you can subscribe free. Account order is free. So the economic study related to capital market is available through websites which you should, as a fund manager, read. Capital market players, leaders, followers. All retailers are followers, all market makers are leaders. The mutual funds, though they come across the leader market, but they are not market makers. They are only investors. They are very big. Each chief executive of mutual fund handles something like 3.5 lakh crores of investment portfolio. So you can understand how big it is. But they are not market makers. That is not their job. They are not expected to. If they do market making, they will pull them down. Market making is given to specialist people who invest money and then they keep huge margins with SEBI. SEBI does not allow them just like that to do trade and then go. No. They are asked to, depending on the exposure, they are expected to keep huge margins. And broker wise there are restrictions are there. Stock wise there are restrictions are there. So they have to deal with number of 10 brokers, 15 brokers, keep money there to buy. So it is they are also committing huge money in the counters of the stocks which they operate. So it is all again a well-oiled system. So the structure of the capital market is very strong and it will only improve. Only thing is valuation should become more reasonable. Importance of FPI, DII. FPIs are the one who are registered foreign investment institutions. They come based on SEBI accreditation with the RBI sub-rules. In each share, there are restrictions for them for how much they can buy in any company. Whereas DII, domestic institutions, don't have any such restrictions. They can freely buy whatever they want without any limit. Banks or LIC or UTI or whatever it is, or the other investment institutions. But foreign investment institutions, they have to go by RBI guidelines, how much as a percentage they can buy each company, combined or individually. If the total quota of foreign investors crosses certain percentage, nobody can buy in that country. They will put a block list. So, in fact, if you find that the quota is over, it is in a way minus point because they cannot come into the stock because they cannot buy. Role of the media. Media is the mouthpiece through which published information of companies is available to you, whether it is print media or electronic media. There again you have to trust the media which you look at it. The trade magazines which are not well reputed is slightly risky. You should not buy them. I mean, buy with their stock recommendation blindly and then go and invest. In fact, it may not happen that way because we are talking about fundamental research, technical research, everything. Then only you are going to be a buyer of the stock as a fund manager. So you don't have to worry about the media, inspired media or vested interest media, because you are not a trader, you are not interested in short-term profits. That is for them. They will say this company is going to do something, the price will move. I remember in 1985 there was a paper called Financial Hazard. It used to be published in every Wednesday in Bombay. People at 4:30, 5 o'clock in the morning, they will stand in queues before the news stall to buy that magazine. Then, whatever stock recommendation they make, even the Financial Hazard, without fail the stock will go. But if you don't fail to make an exit, you are cut. Because most of them were fly-by-night operators. We used to call them not financial wizard, as financial hazard. But that was the power they had in those days. That is what called vested interest media. As an investment manager, you know what to avoid, what to subscribe for, and what to believe. Normally, I believe research reports of standard companies like SBI, Axis, HDFC, ICICI, invariably they give 100% unbiased report based on facts. You can rely on them. In fact, the most dangerous are the foreign research reports. They are highly biased. They will give a report based on their position. And unfortunately, SEBI does not correct them. We see regularly. And the research reporting language they have, it is all Americanized language. It is very, very clever way of saying it is not there, they will say it is there. If you say it is there, it is not there. Both they can write for the same stock. Very clever way of writing, double negatives. If it is a double positive, they will write double negatives. If you read regularly research reports of foreign brokerages, you will know what kind of beautiful language they keep. But they are couching or they are hiding some facts. and they are highlighting something which is not true, or they are giving over importance to that so that they want to act on it. I don't know. There are many people who have raised complaints to SEBI. Sir, these people are having positions in the market and they are giving a report, and so it is influencing the people. But SEBI is little worried because they are all powerful people. That too, they are connected with foreign companies. The ministry also is not that. But a day will come when some scandal breaks up. The ministry also will wake up and then they will take action on these inspired news reports. But anyhow, you can trust our local big banks and big broking houses. Their research reports are more standard and it will give you. Again, based on that, you have to make your own checking or your own analysis. That's what I said. You can't cover all the stocks in the market. If someone gives you a news, say this stock is going to go up or whatever, then you do the need-based research afterwards. Go by the data available. The data will forewarn you what's happened in the last 1 month. It will tell you whether the accumulation has taken place or distribution has taken place. So the data will tell you. So you can do your need-based research fundamentally and technically, and then come to a conclusion whether I want to enter the stock or exit the stock. The importance of research, need-based research I have covered. Paid and free research reports. The paid reports are that you get it from these broking houses. Research reports are, paid reports are professional research houses where they want you to pay an annual subscription so that you can access their specialized industry-wise, company-wise reports. That is, again, the big ones are more reputed for it. You can subscribe to that. For example, Stockage, Money Control. These are all regular things. They do good research. They have been there for ages and then they are reliable. But you have to pay a subscription. It's not free. Companies' annual reports is a very important avenue for research about follow-up share. For 3 years of annual reports, if you study, it's difficult to study the books, certain areas, you will know what is happening in the company, which direction it is going. Then you will also, along with that annual reports, every quarter they publish unaudited reports. That will be for review purpose or upgrading the stock for buying or downgrading the stock for a sale. Now, we are talking about NSE trading and clearing mechanism. The NSE trading is called T+1. You buy today, your share will come to your account tomorrow. You sell today, your money will come to you tomorrow. Because there T+7 it started, it is now T+1. Clearing mechanism is the one which is the NSDL and CDSL. They are maintaining the company's clearing thing where you sell the stock, you have to go through them, buy the stock and credit to your account in the NSDL. They participate in clearing with the stock exchange. Mutual funds, evolution and growth. I said domestic savings, after it goes to fixed deposits, most of the middle class people, the last 15 years, 20 years, they have gone to the mutual funds of subscription. That is today, a very, very large amount is the backing of the stock market. Why it is stable means, the average portfolio holding is less than 4 lakhs. That 4 lakh they have invested over a period of time. In addition to their basic money is in fixed deposits in banks. Plus, initially there will be some house, a flat or something they will have bought. That is important. Then next one is deposits to get a current income. Gold will be simultaneously, they will be doing it. The last one is mutual fund. So, the exposure of individual retail investors in mutual fund is very small. So, they are not panic-driven. They don't panic when the market corrects. They don't go to sell it. They say they don't care. There are 50% of mutual fund investors, they are not even aware. And many elderly people, when they die, when they don't tell their children that they have some investment in mutual funds, there is nobody to even follow it up. And the letter only comes from mutual funds once in a quarter or once in 6 months, some better net assets value, some statements will come, the son will know, oh, my daddy has got something, let us go and find out where he is it. Suppose he has not written up something in a diary, there is a problem. How to follow it up with the institution if we don't have a track? The unclaimed money in mutual funds is 25,000 crores. They want to do it. What they are doing now is, more than 3 years, they are transferring to the government. The government keeps it, you can make the claim from the government directly. This is the same thing as the stock market, stock shares also, individual companies as well as mutual funds. Role of different market players. The market players are, who are there? Domestic institutions, foreign investment institutions, the market makers. Then the retailers. The market movers are the ones who accumulate and distribute. The retailers are the counterparties who buy and sell in a fragmented way. Market makers is a term, it is a legal term approved by SEBI. But we all call them as market operators or market mafia. The mafia is a name of operators who are operating small cap shares, not so good companies. In BSE, 4,600 shares are listed. Out of that, only about 500 shares are investment worthy. And this very same 500 shares are also listed in NSDL. Okay. The radar, if you are an investor today, the what to buy list cannot exceed 500. It can always be less than that. So you can choose some 50 companies to be in your radar, preferably mid-cap companies. Large cap companies do not give you returns. They don't depreciate, they don't appreciate. You are here to give a return for your client. So you must choose mid-cap companies because the 52 weeks movement in share prices is much wider in mid-cap companies. Why I am avoiding small-cap companies? Size is a matter. The market cap of small-cap companies invariably is less than 1,000 crores, which means the liquidity is not there. In times of stress, the price will crash, it will never recover. So avoid small-cap companies. You must consider good large-cap companies or companies in small cap above 5,000 crores. Large cap, mid-cap companies above 20,000 crores. Large cap companies, if some of them correct unduly for some reason, the sector. Some years back, Wipro crashed by 75%. 2-3 years back it happened. From 800 rupees, it came down to 200 rupees. That is an unusual thing because they had some problem. A succession problem or a chief executive problem or whatever. That kind of things can happen in large cap shares also. I think something happened similar to in Vedanta because of some reason, because of some loan problem they had to restructure the loan, the price crashed. But out of for 50 NSE shares or 30 NSE shares, 2 or 3 only will give you that kind of opportunities. Whereas in mid-cap companies, the opportunities, the number of shares are also is more. And then the number of movement and then the opportunities also is more. That is why these days, FIs also moved away slowly from the large cap to mid-cap companies as well. Big mid-cap companies, 30,000 crores market cap like that. So, stock selection is preparation of eligible stock through fundamental analysis and what to buy and market spectrum. Quantitative research is quantitative research. We divide fundamental research into two areas. One is quantitative and one is qualitative. Quantitative is the published financial data. That is annual reports of the last 3-4 years and quarterly reports, comparison of its own performance, director's report, all that. It is fixed for the next 2-3 years, it won't change. That is that basis. Only minor variation will be there. Qualitative is a more important one, which most of the retail investors are not aware. How the market moves, different share companies have different share capital. The lesser the share capital or paid up capital of a company, the more is the discounting factor. The lesser the floating stock of the stock in the market, the more is the PE multiple. So you have to analyze annual reports, balance sheet, profit loss account, quarterly report to understand the ratios, etc. You must also analyze the non-quantitative or qualitative aspects. That is the management's equity. That is, every management has got a name, a reputation. In terms of sincerity, fairness, minority shareholder protection, corporate governance, etc. So, the management equity, corporate growth, brand value, innovation, market share, regulatory factors, local international tariff, inflation, interest rate cycle, everything are affecting the profitability of a company, which are called qualitative factors. Then you have to do economic and industry and sectoral analysis. The certain sectors will go through a churn where they will not be in demand in the stock market. 2 years, 3 years, they will be neglected. Then they will again come back to the forefront. So it is an opportunity for you to get in. See, today, insurance sector or private, the general insurance sector are in demand, life insurance sector has been neglected within the insurance. I don't know why. Because maybe it's regulatory reasons or whatever. Then you will find IT sector, which has got more exposure to US, are questioned, their profitability, visibility is questioned. So for short term, they will be neglected. Like that, it continuously happens. It's not that everything will be, every sector will be going up and again watched every year. It is a sector churning is there. So you should do economic industry analysis, sectoral watch. Capital structure of the company. That is, I said, the paid up value, the total paid up capital, the holding pattern, how much is held by the promoter, how much the foreign institutional holder holds, how much the domestic institution holds, what is the free floating stock, and then whether the promoter has pledged his equity. Normally, a share where the promoters have pledged a significant percentage of holding, people will avoid it. The reason is, he might have pledged it, borrow against his stock, and then used it elsewhere. If he is unable to repay, the person who has loaned against it will wait for certain deadline. If he doesn't pay, he will go and dump it in the stock. Particularly if the stock market volume is very low, then it will get freeze, downward freeze continuously. If you hold some shares in that, you will panic. Actually, it may not be, it will be temporary. It has happened to Vedanta and other big companies also temporarily because they were forced to liquidate. It has happened to many of the big companies, subsequently they recovered. It is dangerous in case of small sector, one-man companies. It's not a group company, it's a single company, single promoter. Invariably, that is a prescription for disaster. So, good managers will avoid small cap companies if they have pledged a substantial percentage of holding. They will not invest in such companies. The business model, competition, segmental position are also for quantitative analysis. See, what is business model? Are they in a business which is subject to competition? It is export oriented, or it's subject to domestic or international competition, or they have a tariff based where tariff can affect it, import tariff or export tariffs or whatever. So that has to be understood. I have already discussed ownership data. The management team, each vertical or each company, it is headed by a well-structured management team. How the company has got a staff, the management, how they have efficiently divided the operating team, the chief executive, divisional heads, etc., how the succession takes place, how the SR team, the HR team works, how it is a promotional policy, all those things have to be considered. Because today, staff attrition is a very big thing, particularly for IT companies and service sector companies, where continuously people move around for higher wages, higher salaries and all that. Then you have high margin companies, low debt companies, low float companies, undervalued companies, take over targets. These are all other areas where you have to look at it when you discuss. Then the market cycle watch. The economic activity all over the world is a big wheel. Certain sectors will be in demand this year, next year they will be neglected, they will come back until the third year. You never know. So you must keep a watch on the sectoral churn. That is very important. Asset-light and debt-free companies. You must have heard about that is what is that? There is one ratio, operating ratio and operating margin ratio. The operating ratio is a ratio where the gross profit is as a ratio to sales. It tells you what is the margin what the company has. The leverage ratio is different. The leverage is, suppose the company is high debt oriented and high asset oriented, which means the fixed cost will be very high. But the advantage is that when the company's revenue goes up, their profitability at the net level zooms up. The reverse is true where IT companies, where they are asset-like companies, so the term loan is less, the interest component is less. So when the profitability comes down in a year and flat growth, the negative side, it impacts the profit loss account adversely compared to that. So the operating leverage either way is a pointer to you. The choice is yours, whether I go for asset-like companies or service sector companies. The same way, debt-free companies or leverage companies. It makes economic sense to leverage comfortably. So, because as long as your returns are more than the cost of funds, it is prudent to borrow. When the cost of funds is below or above the interest rate, returns, naturally it is not worth borrowing and then investing for the returns. So the fund manager, the finance manager or the management will always decide whether they should have what form of structure. You take the case of hotels or hospitals. They are all asset-heavy companies where they have to go for term loans or interest or whatever. It is the structure of their business model is such that you have no choice, you have to do that. For a hospital, it is a mixture of 5-star hotel or a 3-star hotel and a healthcare institution. It's combined. It is not, hotel is only entertain the visitors temporarily and all that. In a hospital, you must go for good medication, surgery and post-surgery healthcare or whatever it is. It is more difficult to do. So the investment card for having a hospital is very high. So naturally the returns will come later. So initially, for the first 4-5 years, they won't even make cash profits. Then they will make cash profit, they won't make good profits because depreciation. Depreciation will be a large factor. Even cash profit may be affected to some extent because of interest outlay. Sometimes these days smart people go for the market and at a high premium, so their debt component comes down. Then the interest also comes down, the profitability shoots up. And the premium also goes to boost their reserves. That means premium is free money, they don't have to service it. It is interest free. So that is why lot of companies these days access the stock market to get free money. And the market is willing to pay the premium. And as I said earlier, these days promoters offload shares at high prices, window dressing the balance sheet just before the issue. And my investors don't care because they ask about the grey market premium, how many times the issue is oversubscribed, and they take a chance to make quick money. The issue gets oversubscribed, so they are happy. And SEBI is not bothered about this sudden window dressing. Say last 3 years, 4 years, balance sheet, certain growth is there. Suddenly in the year of issue, everything goes up, the revenue goes up, the profitability goes up. No investor questions it. SEBI doesn't question it. SEBI says, I have published it, no, it is up to you to take a decision. He is not hiding it, he is receiving the growth. You should ask the question, why, how come it has grown suddenly? How come, why it did not do, last year you didn't do it, this year you are doing it? So you can ask. But investors are interested, 100 share, 200 share, why should you ask questions? I will apply and then I will make some quick money. So that is how it is. The fund manager, the objective is different. He is not going to participate in IPOs. He is interested in an established stock which has been in the market for years, of a company which has got a big pedigree, and it is proven management, proven stock. I will buy only on dips and I will sell on when it goes up. That is how you do portfolio management. Peer group analysis and market leadership. It is very, very important to stay invested or choose investments in established groups with a good track record. For example, Tata Group, or Birlas, or Reliance, or you can name group companies in TVS, or so many such groups are there. Those who have been in the industry for the last 30, 40 years. They are the ones who have established a pedigree, established a record. They are the ones whose shares you can invest based on the price. Because you can trust them for corporate governance, the shareholders, minority shareholders, and then overall fair and true reflection on the balance sheet, taxation accountability, the GST or income tax or whatever it is, compliance. So they are very open and fair. They know they have built up a reputation over the year. They don't want to spoil it just for a small time gain. So that is peer group analysis and market leadership. Within the market, what is market leadership? It is about the leader who has got the highest percentage in the market of the company sector. So the market leadership percentage, whether it is 30%, 40%, 50% is important. This is very important for compounding investments. There is always a choice whether you want short term, 2-3 years you make an exit, or you want to hold the share for 10 years to allow it to compound. It is always a question of judgment. There is always certain features of a share which have compounded multi-levels based on their market shares or their efficiency of allocating resources, their growth in profitability, their new business initiatives, etc. that differentiate them from ordinary middle level companies. Then you come for fundamental analysis. Market looks at revenue growth, consistent revenue growth as a very important factor, consistent EBITDA growth, and consistent EBITDA percentage growth. Now, absolute terms and percentage growth. Market wants to follow that as an important point for discussion. Stock pricing, valuation, absolute, relative, own current peak flows. What is absolute? Absolute is the price at which the stock is available today. You have to individually value it on the basis of the PE multiple it has. These are absolute terms. The relative term is you value it in terms of another company in the same sector or another company of the same size in a slightly different sector. You cannot compare a manufacturing company and a finance company, an IT company and a finance company. Is it not? Because their formula is different, the whole structure is different. You cannot compare. So you need to verify the revenue growth, EBITDA growth, both year on year and quarterly. You see, this is how the market evaluates year on year growth and quarter on quarter growth. See, different sectors need different approach. You cannot have, unfortunately, that is how it is. I believe that the aim of business is to have a return. Pay taxes and then distribute the dividends to shareholder, keep the reserve. If that being so, why should I differentiate between what type of business it is? But for whatever reason, the market keeps it different. For a commodity share, the pricing valuation is low. For a value-added company, it is different. The same group, Tata Steel carries a lesser valuation, Tata Motors carries a higher valuation. See, that is how it is. You can say why it should be. Both are in manufacturing, both are investing money, both are making profits, both are distributing dividend. The growth in the net worth gives you the book value, which is keeping on growing. The earnings is growing. Why I am paying 40p for Tata Motors and 20p for Tata Steel? No answer. That is how it has been. That is always it will be. Banks, you take, at least some reason is there. Public sector banks are available cheaper, private sector banks are available at a high premium. They say is efficiency. Public sector is inefficient, and sometimes the banks, for example, the big banks are merged with loss-making banks. That is a minus factor because the owners are the same. That is a minus factor. Then more current peak and bottoms. You not only compare intra-company, inter-company, you compare inter-company, intra-company also. A stock which has quoted at last 2 years high and has come down to say for 30-40% discount, naturally you should investigate why it is so. As long as the business model has changed, the overall function has not changed, you must look at it as a buying opportunity. Whenever price gets you get a good discount. Technical analysis, you do only technical analysis of those stocks which are in the fundamental cleared buy list. This is a very, very important area what I have earlier indicated. Accumulative and distribution patterns which will be visible when you analyze the historical data of every stock for the last say 3 months. It will show a pattern. From that you can understand what the market maker has done for the stock. It is very, very clear that every stock will be having a downward or upward movement, upward from their correction and all that. That is a function of the market. But the stock in which you are shortlisted, you have shortlisted, you must see what the technical indicator shows. You can always easily master it once you analyze a few stocks, movements, historical data, pricing, it will tell you. So the accumulation distribution pattern, which is the backbone of technical data, is compulsory. That is basic, minimum basic research you should do. Then you have got indicators, that is leading and lagging indicators. The leading indicators are the ones which warn you about the stock, what is going to happen in future. The lagging indicators are the ones which is based on the past. It gives you the data related to the past. You might have heard about DMAs, daily moving average, which is part of the technical data. Very, very important, most important. The daily moving average tells you what has happened to your stock in the last every day, and if you, in the last 1 month, if you see, that tells you a pattern. What is the moving average? It is a sum total of all the volume of business done on a particular day divided by the total price of the total share done divided by the number of shares done. That gives you. That removes the extremes. The market makers will plot high prices and also low prices, but the volume will be very small. So that you have to, that it discards the simple moving averages. So we only take the weighted average of the entire movements in a particular day, that is called weighted price moving average, WPA. That is all available in the NSE site itself. That is plotted in the graph that gives you certain patterns of accumulation and distribution. Volume is the basic foundation of the stock market. There's no point in staying invested in a company which has got very poor volumes. It's a dead trap. You must be in a company which has got reasonable volumes. Normally, stocks which are traded in the future and option market will always have a bigger volume because that is one of the basic norms for listing in the futures market and options market. But anyhow, in keeping as a ratio to the paid up capital of the company to the free float stock available, you must have the volume analysis, the DMA analysis, the accumulation distribution patterns, then what is called retracement theories. I am saying that you must invest only when on a correction, not at the 52-week highs. That is a danger. So you must wait for the correction of the zeroed stocks and then go to buy based on technical information. There are theories for retracement. That is called, a famous theory is called Fibonacci series. The Fibonacci is an Italian person who has for commodity markets has structured certain numbers as a percentage which with regularity is witnessed in the commodities market. That is also applied to the stock market. That is some percentages of the 18%, 28%, 32%, 50%, 64%. These are all theories where everywhere. And the market will always show some resistance and supports at that level, both at the top, going up and coming down. These are all Fibonacci series of retracements. This is also giving pointers. DMA, Fibonacci retracement, bull bear crossovers. That is also a technical indicator which will suggest to you and warn you what is happening in a particular stock in the market. I am only reading the headlines. Quarterly results, technical analysis before and after publication. Normally, many stocks you will find an increase in prices before result publication, and after the publication result depending on the results, it will go up or come down. Invariably, if the price has moved up substantially, even if good results, it will not go up because the operators are moved in anticipation of good results so that the retailers will buy. So invariably we find at the time the professional researchers will say the results is in anticipation of the market. The market has already priced in the results, so there is nothing more interesting in it. So it is neutral, that means it is fairly priced, there is no more action in it. That is what the researchers will tell you. So the quarterly, the price movement before the quarterly result publication is also a pointer for you to make an entry or exit. Why? Sorry, the next one is large cap plus mid cap preferences. Mutual funds always go for large caps because they collect large amounts of money and in the prospectus they tell where they will invest. They will say, we will invest in large caps only above 1 lakh crores. So that's a commitment given, so they will invest only there. If they have diversified funds, combined hybrid funds, they will go for middle, small, large. Even whatever it is there, there is an offer document, they will say according to that only they will invest. But if you look at the total equity holdings of mutual funds, 80% of their money is in large caps. The entire mutual fund industry's money, because that gives them stability and then the capacity to invest, that the money is safe because they are well researched, strong companies. But the returns will not be much. Once in 5 years, like Corona time, the market crashed. At that time, the NAVs were so low that it gave some very high return. State Bank moved from 200 to 1000 in the last 4 years. Now after that, it is now around 1000 for the last 2 years because it has moved up substantially. Whereas mid-cap companies, even Post-market, you will find every year that will give you 30-40% movement up and down. That is where the opportunity comes in well-researched good companies. Power and pitfalls of compounding. Lot of people say, like property, you should say invest in a company for 10 years, 15 years, so that you become multi-baggers. It is very nice, if it can happen, it's very nice. But it's very difficult to predict. And you need extreme patience, because in the 10-15 years of growth, in between 3-4 years, the stock will lie dormant. It will not be testing your patience. At the time, after waiting for 3 years, you will sell it off in business. So, compounding is not easy. It will appear to be a multi-bagger. But for many reasons, the company may diversify in unwanted areas. The company may make mistakes in acquiring inorganic acquisitions. So the balance sheet will they lose profitability. Then they will lose interest in the market. Then the promoter, they may do some mistakes in the judgment in the expansion or diversification. So you can never predict. It's better you encash at the return what you set as a target. That is how you can do it. But what you can probably do is certain portion of the stock you can keep it for compounding if certain indicators are available. For example, a stock, the company is at 50% market share in that sector, then definitely you know that he has been maintaining the high market share. That means either his product or his services is different from the others. He is setting the benchmark, so he is likely to grow faster. So you can hold part of that. It will become multi-bag. A lot of such companies have grown. For example, you have got Force Motors, you have got TVS Motor, you have got Titan. There are so many companies who have become multi-baggers and given compounded returns. But you cannot, except one or two parameters, you cannot judge an ordinary company whether it will become multi-bagger or it will fit in cash. Handling unexpected and adverse news, adversity to opportunity. As a fund manager, you must be prepared to have reserve cash to take the opportunity of investing in a stock which or in a sector which has lost, the market price has come down suddenly considerably. If that being so, it is an opportunity for you to enter. So, this is where you can convert bad news into good news. From unexpected adverse news to opportunity. It can happen and you should be prepared for it to take news, make another opportunity and make money. Fear and greed phenomenon. The fear and greed phenomenon, it is only for traders, not for investors. If you have fear or greed, it is a prescription for disaster. You should not have. You must have conviction and you should have patience. That is the essence of fund management. Traders will have fear of losing their capital and greed to recover all the money lost last year or the last 10 years in 1 year or 1 month. That is the phenomenon of a trader. Those who operate for quick gains, mostly in the option and future segment. You must have heard of option futures. That is not for fund manager. That is for hedgers. For example, mutual funds do take positions in options, but SEBI has put a lot of restrictions. If they have an exposure of 1 crore in a particular stock, 20 lakhs they can hedge in options to generate income for the fund. Something like that they have. They have similar restrictions for foreign funds also. Individual people, there is no such restriction. Option writers, those who sell options are always makers of money. Option buyers are invariably losers. I cannot explain the reason why it is. Big time investors are option writers. They sell options, they never buy options. Because you must have heard what is called an option pricing has two values. One is the time value, another is intrinsic value. While the intrinsic value remains the same, time value is like a Purna Chandra, it becomes Amavasa, decay. And then the Amavasa moon becomes a Purna Chandra, is growth. The same way in option, and passing up every day it loses value because the time component is there. That is why it is priced attractively for retail investors. What is the option? You must know about it. The option buyers have no responsibility to pay the losses. The responsibility is the capital invested in the premium. Beyond that, he does not have to pay. Whereas the option writer takes unlimited responsibility. If suppose he has sold an option for the stock price of 200 rupees, the stock price goes to 300, he has to pay the 100 rupees difference per share. But you have bought a 200 option at 40 rupees. If it comes down, you lose the 40 rupees, doesn't matter, or you can sell it out at 20 and get out. But invariably, you lose. Because the time decay mechanism is loaded against you. Let us assume the stock is 200 rupees. It remains at 199 for the entire 1 month. Your option will lose 100% value. It does not have to crash by 20-30%. Over 1 rupee is enough. As the nearing expiry date comes, expiry date normally the last week, Thursday or Tuesday or whatever. So you have about 4 weeks time. The first 4 weeks beginning, the option is fully pregnant. The delivery takes place or miscarriage takes place on the last day of expiry. But as it nears the delivery time, nearly 75%, 80% of the value is lost. It's a time decay. So the market price may not crash, but the option value crashes. But what happens, sometimes you buy an option for 1 rupee, you can make 100 rupees also. It has also happened. But what is the ratio? 1 out of 50 times. So the punters, they don't mind. They will take the risk. Okay, I will throw as a time. If it comes fine, if it dies, I will try, I will lose it. Doesn't matter. I have not invested big money. That is what is option. So we don't have to worry. But as I said earlier, as a fund manager, you can sell your share, part of it, at a high price and buy it back later and generate an income. That is okay. That is a trusted method that mutual funds also do. That is the only method where you do short-term booking profits or losses. Conviction with confidence in own strategies, prepared to wait for results with loads of passions. First, you must have a strategy, your own strategy, based on your fundamental research and technical research. My strategy is what? I will buy only on correction. I will never buy a share on 52-week highs. Never at the highs. Never. I will wait. First, I will make a fundamental analysis, make a what to buy wish list based on qualitative and quantitative research. From that list, if I have to buy 20 stocks, allocation of capital of the amount money available, I will have 100 stocks at the watch list. And I will buy into any stock which comes to my price. Because I have what? I have got list which it has passed the entry level due to fundamental technical reasons. I buy any such share. And then I will also buy on a structured manner. Suppose I allocate 50 lakhs for one share, 20 counters, it's 10 crores the folio. The entire 50 lakhs I will not buy an A day or B day. I will also again buy slowly. You may say, before you buy 20-40%, if prices move up, let it go happy. I will sell it up at my 40% growth or whatever it is. Put that money in some other stock where it has depreciated within the overall limit. And I also keep that buffer money of 25%, which every fund keeps. We as a portfolio manager, we should also have buffer money to use for whenever such some extraordinary opportunity comes, a stock correction. You should invest money. Beyond the limit also you have set. If TCS or Infosys that is available at cheap prices, you should not, I have already allocated 50 lakhs for it, it is gone beyond it. No, you can make exemptions on a selective basis. Conviction and with confidence in own strategies, prepared to wait for results with loads of patience. For USA market, special emphasis laid on option segment of the derivative market. In US market, investors also go for option because they give 1 year option, 2 year options. That is sufficient, it is attractively priced. So private investors also go for option market. So if you are a fund manager for US equities, option market, stock options is definitely an attractive proposition. For the UK market, it is ISA accounts are there, tax-free stature is there. Middle class investor also will be interested. So initially, before you become big ticket fund manager for HNIs, this kind of your relatives and friends are available. Middle class, salaried middle class is available. They have money in UK. You can take that assignment also. Because in every this clientele acquisition, it comes by words of mouth. If you give returns to a small investor also, you will go and tell 10 people. Oh, he is a man who is very fair, he is heavily efficient, he has given me decent returns, go and see him. And another person also goes in any professional area, word of mouth recommendation is very, very important. A person may not invest big money with you, but he will be instrumental or a catalyst to get you big accounts. So that initial years, you must cater to small investors, satisfy them, show them returns and build up a track record. And what's wrong if you get foreign accounts and you manage that money abroad? You can, if it is an NRA, you can invest in India also, but then you have to contend with double taxation there, double taxation, all etc. things. Maximization mantra. This is what I have been talking about. This is the aim. That is, the returns in the market, the price movements, you have no control over it. It will move the way it is. It is too big for you to do anything. It's the market makers decide on individual stock. But if you have built-in strategies to selectively average based on certain technical strategies and parameters. For example, I will tell you, any stock at my entry level, I buy. If it comes down by 5% from that price, suppose the stock, the recent high was 100 rupees, I am buying at 70 rupees, which I consider is a good buy for the stock based on the valuation and the recent technical parameters and the accumulation distribution pattern DMA. Even then it comes down by 5%. Then I will be willing to average it by 20% of the price I have already paid and price I have already bought. Then suppose it comes down by another 5%. For any reason, I will allocate another 40%. So what happens? The higher the quantity and the lower average price, the holding value of that stock comes down. And that is the essential attribute of a good fund manager. So, maximization comes through good averaging and the good entry point at the lowest bottom level through technical analysis. It also comes through correctly deciding the exit levels based on technicals. You cannot buy at the lowest level, you cannot buy at the sell at the highest level. Particularly when you manage individual accounts, it's not possible. Even large accounts, big funds, how you can do it? But you can stagger the sale on an uptrend based on technical parameters and get a higher average sale price. Like lower average buy price, you get a higher average sale price, which means the margin goes up. Then leverage it, how it happens? The stock based on DMA corrects sufficiently, then you enter into it. After every correction is followed by a period of consolidation, sideways movement. That is for a time correction also, it will be there 2 months, 3 months, 4 months. Then when it starts moving up, the reversal, retraction, the indicators will tell you a story. The 5 days, 20-day moving average will tell you, along with the volume, the operators have started accumulating, they are now pushing it through. At that time, it is right for you to leverage it by borrowing money, which is available in the system itself. You don't go to a bank or anybody. You don't leverage blindly for the entire portfolio. Only the stock which is corrected and reverse, consolidated reverse, it is an upward move at that stage for 1 month or 15 days to borrow from the brokerage itself. They will give you around 10% interest fee. Now what happens? That portion of the stock, once it has moved up by 10-12% within 10 days, 15 days, you exit. Because every day you have to pay interest. So the cost of funds should be as low as possible. So you exit. What is this? What do I mean by that? You said you are not burdening with the debt for the entire portfolio. You are only burdening the debt component as less than say 5% of the total portfolio, which is manageable. And that debt is for a limited period for a stock which is showing momentum, reversal momentum. So, what happens? That extra profits increases your yield. Like that, it is possible to do in every stock which is under review, and it is being done by mutual funds, it is being done by fund managers also. The maximization is not easy. It requires expertise, but it is possible and it is being done. And you must do it. You must be. You must specialize on that area. Otherwise, if you are only complying with the index growth and matching it, it is not. You are always beat the index. Sectoral index or overall index. It is a challenge for you to beat the index, give higher return. That is how you will get good clients. So ultimately what I am saying is, you must master the fundamental analysis, technical analysis, know the tools where it exists, know where the information can be taken, make an analysis and be ready. And through the technical information, what you get, the data crunching or the moving averages and the volume analysis, then you make an entry. And then you set a goal, discussing with the client, what is the return you are expecting, 30% or 40%. So stock-wise you have a limit, and overall portfolio you have a limit, and then you are also doing some leveraging, and then increase the limit, increase the returns. Then you justify that return I am getting. You can do it, it is possible to do it, provided you do your homework and have faith in your strategies and commitment and self-belief. Beyond all that, patience. You as a fund manager, you should shut your ears to market noise. Good fund managers will never look at the market movement on a daily basis. They will not see the screen. They will go by the data. Then the office people will send them a note if something new or something substantial has happened. Otherwise, he say, something we go, you got other things to do. Because he has to look at new schemes, new development, so many things are there. I am not interested. As a trader, if I am close to the market, I make more mistakes. My mind is clouded. My mind is easily changed. That is what the market makers want. They make you doubt your own intelligence, doubt your own belief, and make you sell because the greed and fear, the fear of losing the capital and the greed that you also overextend to cover whatever past losses are there. That is why you go to futures and option market. Somebody says it's quick money. Money is never easy anywhere. You have to earn it your hard way only. So fund management, it requires a lot of hard work. But as a CA, when you go and do your practice, it takes some years for you to establish yourself. Right? Unless you go into the shoes of your father, it's a ready-made practice, that's a different story. Any CA, any doctor, or a lawyer, or a builder, anybody, they go slowly only establish the name. The same way as a fund manager, initially you must manage small amount of funds for small investors and learn it first time, make mistakes and learn it, unlearn, and then show record, and then the record will speak for you. Then automatically big funds will chase you. Because I tell you, there is an absolute depth of individual fund managers all over India. And it's likely to be there because my feedback is that professionals are not fully aware of the potential and they always have a judgment about the market through their individual mistake they have done or the mistake their friends have done. What might have really happened is you would have over-speculated or you must have chosen wrong stocks on wrong recommendations. You might not have followed the essential principles. Only people who do their homework well and do investment based on strategies, well-founded theories, and above all, people who wait for 2 years, 3 years of return as individuals also, they will only make money. Most people confuse between trading and investment. Even, sir, I only invested, I have not speculated. They don't understand. Speculation is closely related with trading and investment. Many times we confuse ourselves. Sir, I have bought a stock only. At what price? And what is your capital? How much you have bought? You want to make it quick money. You might have bought the same stock in futures position also, where you can do an average of 5 times. The margin is about 25% in futures. The same stock, good stock, you can buy in futures. But then the volume is so high, you can't handle it. So, as an investor, you do wire correction and wait and sell out on your returns, your target returns are achieved. Do partial exits and re-enter. That is also a very trusted method. So these, the sum total of all these things is, it is the only and surest way to show success in fund management to improve your return to the client. And in that way, you will also become prosperous, and then ultimately that will lead to be a family practice also. The advantages here is there is no prescribed qualification. Any graduate can become. You have to register by passing a simple examination. It's not difficult for a particular CA to get a license from SEBI. There are some restrictions on the capital of the company who has a fund manager, portfolio manager, that you have to find out some ways and means to circumvent it. I don't think it's not difficult. You can do it. A lot of people have done it. How to comply with it? I'm not saying circumvent, comply, structure it. But all the trouble and the time you spend is well worth because the returns are mind-boggling. And the market is growing, it's exploding. So, small cake, small nanoparticle cake only you are expecting. A 100 crores portfolio in the emerging market, in the growing market is chicken feed. For us, as individuals, it's a larger money, but for the market, it is very small. So it is possible to achieve such kind of growth, provided you show good track record. That you have to start slowly and then make money for others, earn a reputation of being a fair and sincere fund manager, accountable. The biggest advantage you have these days is that all the back office work is done by the broker. You don't have to do anything. It is done in electronic form, 24/7. The client can upload it or download it. And then you are not handling the client's money. It's very transparent. So the client will trust you because you are not touching his money. He is account holder. You are giving only instruction to the broking company to buy or sell. You are not handling his money. The company gives them accounts, cash ledger, the script ledger, bought and sold statements, holding position, everything is there. So you are being transparent. You don't have the worry of cash management, etc. You only look after the growth and maximizing the return. In the olden days, you were allowed to use clients' money. Everybody was using it. That was added responsibility. Today, you are prohibited. It's a blessing in disguise. You cannot do it. Then how will you make mistakes? And you are fully protected by the agreement you make with the client. Even in unfortunate state of your previous client wants to close it. For some reason, he doesn't give time because he needs the money. You will not be blamed. It's a bipartite agreement as per SEBI law, SEBI guidelines. You are fully protected. And you don't have to have needless responsibility, accountability. You do your fund management efficiently as possible. Be sincere to him. See, 12%, 13% return is more than enough for high net worth individuals. See, every high net worth individual will have some business. You go and ask him, sir, it's a daily headache, sir. Some general manager leaves, I have to reappoint. Some problem here, some problem there. As a stock investor, you are running on the shoulder of an efficient company. You don't know what they are doing. They do all the dirty work. You ride on their piggyback, their profitability. Where else you can get the choice? This is the only way in stock investments you have the chance to make big money on others' hard work. So I appeal to you, or rather urge you, to look at this option seriously as a career option and go read deep into it. It doesn't matter whether I give training or not. I have ready way to train you and make you a fully rounded fund manager. But there are others also is possible, or you can learn yourself also. Look at this. Please look at this as one of the options for your career. 100%, if you are sincere, if you was a lot of time and energy, you can succeed. Thank you for listening to me. Any questions, please? $820 is there. Some more time, any interaction?
Sir, here.
With the mic.
Yes, sir. So I have two questions. One is that yesterday, 7:30 p.m., the US GDP data has been announced.
Pardon?
Yesterday, 7:30 p.m., the US GDP data has been announced, and surprisingly, they have declared 4.3%.
Yeah.
To the contrary expectation of 3.2 or 3.6%.
Beyond that, but yeah.
And the gold market has totally disrespected it and crossed, and it has hit the all-time high. So from the Indian chart,
market?
gold market.
Okay.
Both MCX,
What, silver also?
both silver, both MCX and Comex gold. So from the chartered accountant perspective, I am asking you, how really strong is the US GDP number which is declared, which may also be a makeup? And what is the Indian scenario, which is almost 7 to 8% vis-a-vis the Chinese,
I'm telling you,
which is
basically
really
you have to
industrially
understand
strong?
the GDP number is a comparative number of a previous base period. You don't know what is the base. If the last year base is low, your corresponding number will be high, denominator numerator difference. If the high base is there, even though you do well, the GDP comparison rate will be low. It's not an absolute number, it's a relative number.
Yes, sir, because
And then
the
what?
labor numbers are very bad.
Yeah, and the component that going to make a GDP is constantly revised. You don't know whether how they do it. For example, in the US, the cost of living index, they include rental also. In some other countries, they don't include. Is it not? So different countries follow different yardstick for coming out for numbers. The US GDP number, if it results in strong dollar, then we should worry.
Yeah.
We are not worried. We don't worry about the stock prices or whatever it is. If the dollar becomes much stronger, there will be reverse flow of capital from India to US. That will again push pressure on the rupee price and also on the flight of capital, which will affect our reserves. But if the GDP is good and it results in good stock prices and overall economic growth, it's good. See, always we should be good for others, you know. That also sometimes will rub on us. But we don't know. Gold and silver, it is going up because of actual buying by central banks of most countries because they are hedging this against American dollar. That is the reason. Silver is being used more for industrial purposes. But from the batteries and EVs, semiconductors, so many things. Actually, it's consumed. It is not speculative. You cannot speculate in the big way market will be exposed if you do in gold and silver. Even crude, you can't do it. So, this GDP growth in America is good. India also is, last month we have shown this quarterly GDP, 1.5% more than expected, no? That's all good.
So one more thing, what are your indicators when you do the technical analysis? What are the major top 3 indicators you use always?
I have already described in detail. I look at accumulation distribution pattern. First, that is the most important. Accumulation distribution through volume and DMA analysis, moving average analysis, volume weighted price analysis. That will give you a pattern of distribution or accumulation. So, price movement compared with volumes and the moving averages, it tells you a story. That is the old method. Commodities market is there. Even today, the new players may come. They will talk about valuation metrics, talking about DCF method, this method and all that method. All this, see, DCF is a method used for private equity. It is not a listed company. You don't have PE ratios for unlisted shares. How do you evaluate future growth? DCF is one method. Is it not? That doesn't apply to listed shares. For example, I told you, stock market is not an ideal place. The fundamental market balance sheet, profit loss upon growth, you say, may not necessarily result in price movement up or down. It has got its own methodology to value a share. It is based on so many other reasons. It is not purely because of fundamentals. Fundamentals is important, but technical, as I told you, the floating stock, what is likely to be the market supply and demand, and what is the perception of the market maker. There are so many factors, hidden, known and unknown. But as an investor, you have to only apply what is the data available to you which is published from dependable sources. That is what you can rely on. For example, you balance sheet, you trust. How good do you know it is not window trust? How true it is? There are some ways to judge it. There are certain methods you can see whether there is consistency in the statements, whether the data are validated, value for the sale process, it goes along with the data split, there is some problem. The sales comes down, the stock moves up suddenly, and the data, it does not correspond in the recovery within 180 days, beyond 6 months it doesn't, it has gone up. There are so many things you have to see. But beyond that, what is you have? But the researchers we closely watch. Those who have already invested in the company, they ask several questions to the finance manager of the company or the general manager of finance. They get more information. So they can understand better than us because they specialize on that company or on that sector. They can make intra and intercompany comparison better. But for us, we have to trust information that is coming from established players like State Bank, ICICI, HDFC, Axis Bank, that type of big companies. As I told you, foreign brokerages have become least trustworthy. They are no longer dependable. They are highly, they move after they take positions in the market. This is very, very evident. And sometime or other, SEBI is going to catch them and they are going to be punished. It is very bad.
Unethical.
Unethical. Yes.
So whether registration with SEBI is a must to become a fund manager?
Pardon?
Whether registration with SEBI is a must to become a fund manager? Can a practicing CA become a fund manager?
You have to leave that and go.
Surrender.
Naturally, that is the issue guidance. But why not? If the opportunity becomes, after stabilizing, I don't have to tell you how to structure your fund management obligation or opportunities without compliance with the institute. There are many ways I don't have to tell you in this open forum. Yeah.
Yeah, hi sir. Thanks for the lecture. So, how can we practically implement this, whatever you've spoken about? Like, we need to experiment with our own money. Like, imagine we are already having a practice or
Whether it is your money or others' money, the root is the same, everything is the same. If suppose your family, someone trusts you, some cousin of you, or so you say, I am going to be a fund manager, I have got exposure to it, I have studied, I am going to do it. He trusts you. Take it. The point is, you must manage that money as if it is your own money. And then go through the trained route which you have mastered. And if you do this conservative fund management which I suggested, you will not make mistakes. First thing you must accept that every stock when you buy can come down. As it can go up, it can come down. It is inevitable. But if you have entered at a reasonable levels, the bottom is protected. I told you, beginning itself, properties do not depreciate. It may not appreciate, it doesn't depreciate. Have you seen a property in the heart of Bengaluru, which is sold for 10 crores, available 8 crores 2 years later? Unless there is some problem with the ownership litigation, something like that. Otherwise, normally it will not. Because that area, that property, the price is there. In some other area, it may be for 10% less or 10% more. It will move in the same fashion. So, you don't get opportunities. Gold, it can remain stagnant or come by small correction. But gold market, the problem here is, these damages, ceremony or whatever, making charges on that kind of thing, it eats away almost all your money there. But you want to buy a necklace, it is about 20%. You have to pay additional for the against the price of the gold you buy. The same way you sell it also, they will take 15%, 10% for damages. So, the same way housing also 9% upfront you have to pay registration charges. Then stock, there is nothing like that, very small amount. And then if you hold it once in 1 year or 2 years, you sell it, there is hardly any cost except the dematerialization charges for the NSDL site. That is very small amount. So, What is that? How to go about, you ask in one way. First, I equip myself with knowledge. How to do it. Then, if a client comes, I buy money, go and open an account with a good broker. Preferably in a banking institution like HBI, State Bank, because your money is safe. Then, even if some staff does with some misappropriation, the bank guarantees your money or the It's risky to trust private people because all of the aim may be good, sometimes some problem may come, they may not be able to meet the commitments. So avoid private stockbrokers, go to institutional stockbrokers. All the banks are having stockbrokers, and you can link that SB account or whatever account to them, so you don't lose interest also. Then the client will open an account, putting you as an authorized representative in the account opening itself. Then the stockbroking company will give you the password which it gives the ID, trading ID and password what he gives to the client, will give it to you. So you open the computer, you put buy order, sell orders or whatever it is. Or make a phone call, your voice will be recorded in the broking house, your phone number will be recorded. So that they will recognize that you are the genuine person, they will implement the order. If you don't want to do it yourself. So, your decision on behalf of the client or your own funds, what to buy and when to buy, and when to sell, when to re-enter, how to average, how to leverage. These are all decisions you take. Initially, it's good. You grow with small accounts, you can make mistakes and learn. Market will test you, but if you are sound, you can wait with patience, you will succeed. It's not that challenges will not come, it will come. In auditing, you are only a service provider. That is, you have got honesty, sincerity in doing the audit function, and depending on the nature of the work, if it is a balance sheet audit, it's a two-way balance statement to the shareholders. If it is income tax filing, it is something else. So, you do a service one, you are not accountable for any profit or loss. Whereas, if you are an employee in a company, similar, as long as he does not do any fraud, if he doesn't deliver as a functionary, he will be thrown out, but you will not be responsible. Even as a fund manager, if you followed the agreement and followed the procedures laid down by SEBI, you cannot be held accountant unless you have done some cheating or fraud. You are not responsible even if there is a loss. Legally, nobody can catch you. So, first to train yourself, then if you say that the best way is to show some track record is invest my own money and then you invest others, that is also fine. But somebody has to trust you and give you a small amount and then you show the record from that is how it has to come. I don't know what is the other way. These are the only way it's available to you. But you must prepare yourself and equip yourself with the knowledge and expertise to be able to take the responsibility of managing others' money. That is very important. Initially, you don't lose your job. In fact, I think people who are in employment, it is easy for them to leave the job and come and take this as a profession. There are people who are already in practice. Because they have tried and toiled for 10 years to set up a practice. They will not be easily interested in changing to fund management. I don't foresee people who are well established, for example, our chairman will not come and do fund management because he has worked for so many years to build up his practice. He won't. I am looking at people, essentially my target is to appeal to people who are employees. They like choosing another employment, they can also look at it. They can do side by side with that because there is no institute. CA institute doesn't allow you, it is professional ethics not to allow you to do concurrently do asset management along with your practice. If you are in employment, that ethics doesn't apply you. It is left to the employer to give you permission. He may give or he may not give, that is different. But anyhow, you have to go through the same route to establish your credibility so that you can. Ultimate aim is to manage big time money. That is what I am attempting to tell you. Look at it as a career and you can say fifth option. There are 4 options already with you. One is practice, another is employment with financial service industry or manufacturing or consulting or going abroad. This is the fifth option. And you don't need capital for it. Somebody's money you are going to manage ultimately. And as I told you, the immediate advantage, the overhead does not shoot up commensurate with the increase in the assets under management. Right? Back office work is not there, it is for the broker to do it. You are not accountable, you are not, as long as you are honest. Okay, so many plus points are there. I think you cannot just ignore all that. Enterprising young CAs will look at it seriously. I don't know how many more people like us will knock at the door, but it is an exercise worth doing it with the fond hope that somebody will respond and we can train them and make them fit and eligible to be a good fund manager, give good returns to big investors and return prosper. Thank you.
Couple of announcements before we close. Members kindly register for 6-hour CP program on 26th December 2025 and there is another one 3-hour CP program on 27th of December 2025 by logging on to Bangalore Bank website. Members, a big round of applause for that fantastic discussion on the topic. Thank you so much, sir, for your time and effort. A 5 decade of experience garnished with letting the fellow professionals know the professional opportunities is commendable, sir. Thank you so much. Once again, on behalf of members present here and all the managing committee members of Bangalore branch, we would like to hand over a memento to the speaker as a token of gratitude and respect. May I call upon CS Satish sir to come out to us and then to us. Thank you, sir. Thank you very much.
Anybody who wants to get in touch with me, you can call Ms. Sangeeta, the coordinator here.
Numbers will get.
Yeah, we will share. So you can get some contact communication from her.
Maybe the 35th slide was having your contact number, I guess.
No, I removed it.
Okay, good.
That was with the firm name.
Yes, sir.
Normally it is not allowed.